when you go from 2.4 mil to 3.7 mil in a few months, I'll take that every single time. This stock does not deserve to be down the way it was today, okay? You just got a massive discount because people are lazy and the algos are lazy and they have no clue what's going on here. If this is scaring you, if this is shaking you up, you better get ready because this is nothing. You send many of the most popular stocks in the market down 50 to 80%. Now we're talking. Now that's big dog stuff, right? And there'll be plenty of stocks over the next 5, 10, 15 years that will make people life-changing money. No one should have that much money, right? And this like false notion about like, oh, they won, so I lost, right? Like we lost that money today. Like, no, that's not how it works. There aren't a lot of opportunities in the market I can see out there that in the next 24 to 36 months, I feel like I'm gonna double or triple on my money. I don't usually do that, but the results were so insane that I actually had to completely readjust my projections. You gotta be flipping my flapjacks, ladies and gentlemen. Do we have a lot to get into here today, including I spent 6 figures plus on some stocks here today. Okay, we got so much to get into. Public count down a whopping $257,000 here today. That's a holy smoke, as this ain't no dang jokas right on the floor type day, okay? We call that a bloodbath. It was an absolute bloodbath out there here today. My 2 biggest expenses, to put this amount in context, last year in 2024 was one, I did this pool, spa, fountain wall in my backyard, by the way. Best money I might have ever spent. The kids and I have enjoyed that thoroughly. $120,000 that was, right? And then the other big expense I had last year was I bought the Ferrari. That was $240,000 cash after all the taxes and all that, right? And so, yeah, it was definitely a big number. Like you could build a couple pools for that much, very nice pools, right? Now, we got to put this into context, right? Because back in April, the public count, you know how much it was? $2.4 million. So yeah, we are down huge today, right around 3.7 mil. But gosh, when you go from 2.4 mil to 3.7 mil in a few months, I'll take that every single time. Like, yeah, we're down from the top, but like that's still an incredible run we had over the past several months, right? And not only that, we've had an incredible run the past 3 years. Look at where the public count was 35 months ago, less than 3 years ago. Public count was sitting right around $1 million. And here today, it's almost $3.7 million, right? So sometimes you just gotta like widen the view a little bit and you realize, oh man, like we have a lot to be thankful for here, do we not? Now, with that being said, there's damage out there, damage all over the place. Elf down 35% here today. Honest down about 30%. Celsius down 24, almost 25%. SoFi was down about 10%. Fubo down 7%. AMD down 7%. Palantir, and by the way, look at how big AMD's gotten to be such a big position that even a 7% move up or down now, we're talking $50,000 for that stock, right? Palantir down almost 7 percentage points here today. There was some damage out there here today. We have a lot to get through. Celsius, this stock fell off a cliff today. Is this an incredible buying opportunity? We'll speak about that in this video here today, okay? Elf Beauty was the worst stock in the whole stock market today. The worst stock in the market, down 35%. We'll speak about this incredible opportunity in regards to Elf. Honest stock, the market cap on Honest is all the way down to $259 million. We're going to speak about Honest if there's a huge opportunity there. Then I'm going to share with you the stocks I put 6 figures in today. We'll speak about that in this video here today. Then we're going to get into some reactions. I want to react to this one from this analyst, BTIG, Jonathan Krinsky, on the S&P 500 going to 6,500. We know Tom Lee's talking about 7,500 by year end. Boy, do we have some differing opinions out there, right? Elf fell off the shelf. We're going to speak about that stock and listen to an analyst speak about it and kind of share my perspective and opinions. Elf is a very good company, but expectations were high going into the print. And then last up here, looking forward to Robert Frank, who really studies the high net worth, the super high net worth individuals, talking about how they're managing their money right now. I want to share my perspective and opinions on that here today. One thing and one thing only I need from you guys on a day like today. If you could just hit that thumbs up button, even if you're somebody that doesn't usually hit the thumbs up, can you just do that for me here today, okay? My public count was down 257,000. I hope it's not too much to ask for just a thumbs up. You know, please don't be stingy with the thumbs up for you, man. I stay out here for you guys. I don't care if it's a bull market, a bear market, a kangaroo market. I love making you guys content. I love teaching all the stuff I've learned over the past 17 years and, you know, taking things up to a higher level and keeping you guys focused on the long term, right? Pin comment down there here today will be to apply to my private stock group. People thought like, oh, you know, with Bitcoin falling and like financial assets in general falling, a lot of stocks going down right now, would demand weaken? Literally today, we're going to have the most members join the private stock group in the history of the private stock group today. I just added up the numbers of how many members have joined. I'm like, this is going to be a record breaker by far. So if you want to join us in there, I'm considering basically shutting the group off to new members once we hit 3,000 members, and we're at 2,875 members right now, and then reopening it at some point in time in 2026. So if you want to join us in there, that will be the pinned comment down there. I'm super happy. Like people are, don't care about what their account says in the next 3 weeks, 3 months, 6 months. They care about what their portfolio says 3 years, 5 years, 7 years, 10 years from now, right? And when you go through my course curriculums, when you learn everything, right? When you get 1000x access, your chances you're going to have success in the market go up dramatically if you actually know what you're doing, right? If you look at me, I've been able to get through all the bear markets. On the bull markets, I make more money than I could have ever dreamt, right? Like, think about how much all my private portfolios are up as well. Think about, like, what do I own in my private portfolios? It's all the same dang stocks I own in the public account. So you imagine where my net worth has gone over the last 10 years, 5 years, 3 years, those sorts of things, right? And we've been able to have so many folks go through that, private group and reach 7 figures plus, right? I think we've had over 200 people scale their portfolio now to over $1 million, and some over $10 million. And we've had probably 700, 800 people scale to 6 figures plus. So yeah, the results speak for themselves. Pin comment down there to join us. Okay. Celsius Holdings. Listen, ladies and gentlemen, this stock does not deserve to be down the way it was today. Okay. There's some other stocks that were down huge today, and I'm like, I get it. Celsius, no. Not only should this stock not have been down, I could make a strong argument that it should have been up today. And that I can't say the same about a lot of the stocks that were down today. This one I can, okay? They reported a B grade income statement. Now, this would have been an A plus grade if it were not for one thing, okay? So look at this. Revenue came in at $725 million. That's versus $265 million in the same quarter last year. Gross profit went to $372 million in this quarter from $122 million in the same quarter last year. But look at this right here. They had this one-off expense line item, distribution termination. It was a $246 million one-off here. Okay. So that made their profitability look horrible, right? It made them look like they lost money in those sorts of things. But we have a private stock group member that did a little digging in regards to this. This is one of the other beautiful things about having the private group. We're all digging into these stocks all the time, running projections, keeping up with the news. Look at what one of our members found here in regards to this distribution agreement. Okay. PepsiCo has agreed to fund the termination fees associated with moving a significant portion of Alani Nu into the PepsiCo distribution system, resulting in net neutral cash position for the company. While the company's cash position will not be affected by the termination process, generally accepted accounting principles require the company to record the estimated termination expenses on the income statement. While the payments received from PepsiCo to fund such terminations are required to be recorded on the balance sheet and amortized over the life of the distribution agreement, resulting in a timing difference on the income statement. Ladies and gentlemen, that one-off is like the most fake one-off ever. Like, this is the best situation you could have imagined here, okay? So this is what just happened with Celsius. You just got a massive discount because people are lazy and the algos are lazy and they have no clue what's going on here. And so they think the company just took $250 million one-off fee when PepsiCo's funding it, right? Like, are you kidding me? Like, you gotta be flipping my flapjacks. This is insanity. What happened in Celsius stock is insanity. And that's why I say there's a lot of other stocks that fell big today. And like, I could make a strong argument why they fell, right? Some of them definitely fell way too much. I'll be honest about that. But like, I could understand them not going up on their earnings. This was the one that I'm like, this stock should have been up today. This stock should have been, they just made a massive mistake in regards to this one. But some people do the research and do the digging and find out things and others don't, right? And that's the stock market for you. Now, what are my projections for Celsius? Okay. So here are my projections for Celsius and where the stock is going over the next few years. Basically for every case I have for Celsius is revenues are going to go up about 30% range next year in 2026. And then 100% net income growth there because they're not going to have that one-off next year. Okay. Now, I think honestly, I'm going conservative on both those numbers because you got to remember the Rockstar will be full year impact positive 26, and then Alani is going to be part year, right? Where they weren't in 26. So that's going to help revenue growth as well. And then we know the Celsius brand is growing and we know international. So I think 30%, I'm actually being conservative for all three of these cases regarding revenue. And I think I'm also being conservative with 100% net income growth because remember, there's a $246 million hit they had to take here in 25. That then's going to not be a hit in 26. Remember that. And then like profitability should go up quite substantially next year because you know why? They're not going to have any of these one-off like expenses in regards to the acquisitions like they had this year with Alani, with Rockstar. So honestly, could this company have net income next year of 600, 700, and maybe $800 million? The answer is yes. But I wanted to, like, would I be shocked if Celsius had net income of $700 million next year? Not at all. 0% I would be surprised. But I wanted to go more conservative. I want to have them a little less than $500 million in net income in 2026 for this company, okay? So that's how I ran all my scenarios. Now, additionally, for my bull case, I ran them only revenue growth of 15% per year, 27 through 29. That also might end up being a conservative number. When you think about Celsius's growing brand, when you think about internationals, like they're just starting to really get to that international opportunity, right? When you think about the Alani, obviously scaling of that business, I mean, 15% might end up being conservative. And then remember price increases over the years and things like that, right? And then I have them doing 25% net income growth. They should get a lot of leverage on that, bottom line over the coming years as they scaled out. They don't really need to hire a ton more employees. They've done a lot of the hiring in the past couple of years, and now they got the Rockstar team, the Alani team, all that. If anything, they might actually lighten up on employees, in my opinion, over the next year or two. So net income should go up way more substantially than revenue should actually go up for the company. Okay, so I've been getting $900 million in net income in 2029 under my bull case scenario. 35 to 40p would be fair for a company growing top line 15%, bottom line 25% in the drink industry. And so that would give me a compound annual growth rate well into the 30s, ladies and gentlemen, well into the 30s. Now, keep in mind, 26 is such a key year because if they were to grow that net income to 600 to 700, $800 million next year, keep in mind that completely fundamentally changes all these estimates. Then we could be talking about, like, let me show you how much this changes it, okay? So let's say they grow net income next year by, I don't want to go, that's probably a little too much, okay? Let's say they grow it by 150% next year. So they push to 579 million. Look what that just did to my numbers here, okay? Now we're talking about CAGRs into the 40s regarding this company. So this is why 2026 is going to matter so much for what their net income is. Okay. Keep that in mind for next year. Pay attention to net income because it's going to completely change these numbers here. I think I went very conservative with being net income of 463 million next year. That's a net income margin of only 14% roughly. Keep that in mind, ladies and gentlemen. Okay. Base case for this company. This is basically just a fancy way of saying what I expect, right? Kept all the numbers for 26 the same across all the cases. Then I have them only doing 10% revenue growth on average, 27 to 29. Is that not a conservative number? I think that's pretty darn conservative. 15% net income growth. If you got a company in the drink industry growing top line 10%, bottom line 15%, 28 to 33p is very fair for that company. And we're talking about a CAGR midpoint right around 20%, right? And once again, watch how this changes if we're talking about that profitability in 26 is a lot better, right? Look at how this changes my case. Now we're talking about the compound annual growth rate is actually going to be more toward the 25 to maybe even close to 30% range. Whew. Yeah, this is why like Celsius should not have sold off today. It was ridiculous, okay? And revenue, as far as the bear case for the stock, I'm only doing 5% revenue growth, 5% net income growth. Yeah, and if that scenario plays out, like it's going to be hard to make money in Celsius over the next few years, but not a very realistic scenario there, right? So Celsius this is a huge gift. There's no other way I can put it. Like if people are buying Celsius stock in these prices, like they just got a massive gift here today. And all you can say is thank you very much for that. Because it looks clear to me that Celsius is on its way to becoming the next drink giant. And when we start talking about drink giants, we're talking about 50 billion, $100 billion plus market caps, right? They're 15 billion. So there's a long way to go in this party. All right. Next one up here, Elf Beauty. Oh boy. Let me take a drink before we talk this one. Okay. This one got hammered today. Now, should Elf have been down? Yes. Elf should have been down today. Should e.l.f. have been down 35 percentage points today? Absolutely not. I believe the company deserved to get dinged today, right? Because they missed their revenue estimates, and that like people pay attention to revenue estimates more than anything in regards to e.l.f. So the stock should have been down. The stock should have been down 5 to 15%. Not 35%. This was way like just the market being ridiculous. Okay. Here are my e.l.f. estimates for this company over the next, 4 years roughly. Okay. Here's my bull case for e.l.f. 25% revenue growth in 26, right? Because they're going to have the full road deal, that's going to be fully integrated in 26 for the company, right? So their revenue should be very strong. The company's guided for 18 to 20%. I think they're guiding low because they missed revenue estimates 2 straight quarters. So I think they want to do numbers that they know they can easily beat. That's my personal opinion. Okay. So 25% revenue growth in 26, and then doing 20% revenue growth per year, 27 through 29, 35% net income growth in 26, and then 30% net income growth, 27 through 29. They should be able to run that business very lean. My guess is in 26, they'll probably get a lot of the cost out of the business. They're probably going to have a lot of duplicated roles because of the acquisitions they've done over the next few years. So I wouldn't be surprised if they do a layoff and maybe clear out some employees or something like that, or they just keep the current team and just basically have like a hiring freeze for the next, few years, in my opinion. I don't think they need to do hiring in any substantial way for the next several years, essentially. Okay. So net income growth there, 35 to 40 PE would be very fair for this company if they're growing revenues 20% a year and net income 30% a year, right? And we're talking about a compounded annual growth rate of 40-ish%. 40-ish% under that scenario. We're talking about a stock that goes to the high 200s to low 300s. Today, the stock, you can buy it for $76. Pretty attractive. Here's my base case. This is just a fancy way of saying what I expect for the company. I expect them to grow revenue 23% in 2026. I expect their net income to actually not go up that much next year under my base case, essentially. I'm expecting only 15% growth for net income. All right. Then I have their their revenue going to 15% growth per year, 27 through 29, and 20% net income growth per year, 27 through 29. If you got 15% top line for a cosmetics company, 20% bottom line, 30 to 35 P is very fair for a company like that, right? Because people just keep rebuying these products again and again and again. That gives me a compounded annual growth rate in the 20s. e.l.f.'s a buy today. e.l.f. is a flat out buy today. Will e.l.f. stock go up in the next 3 weeks? Who knows? Who cares? The bottom line is e.l.f. stock is going to be on its way closer to $200 over the next few years than it is, $50 over the next few years. So are those numbers like crazy? Like, no, those are, if you're educated on e.l.f. stock, you'd be like, that's pretty like conservative numbers, if anything, right? My bear case for e.l.f. has them only growing revenue 18%, the low end of their range in 26, with no net income growth next year. Then only 9% revenue growth per year after that. And only 9% net income growth per year after that. 23 to 28 P, and I still make money. Like, those are dog dirt numbers there. Those are dog dirt numbers. Oh, gosh. Put them in the pig pen with the mud. That's what type of numbers those are. And I still make money. Not much money, but I would still make money. If I can still make money in a bear case, it looks pretty attractive. So e.l.f., huge gift. Where's the next $20 for e.l.f.? I have no clue. I don't know if the next $20 is down or up. I don't know if the stock's going to be $56 or $96 next. But I think I know where the next $100 to $200 is, and it's to the upside. Okay. Bottom line in regards to that. Honest company. Alrighty. Honest company. Next up here. 30% hit today. This one, did it deserve to be down? Yes. Did it deserve to be down 30%? No, absolutely not. This is silly. Stock should have been down 5 to 10%. This is silly. Okay, $259 million market cap. Keep in mind, the company has cash and cash equivalents right now of like over $70 million with no debt. And they keep bringing in money. So this was ridiculous. Okay. Now, people are freaking out about the diaper business, right? The diaper business fluctuates crazy because a lot of it depends on when Target or some of the other retailers place their orders. Okay. Sometimes Target and other retailers will place a massive order and, honest diaper revenues go flying. And sometimes they don't place a big order during a quarter. And guess what? big order during a quarter. We're rhyming. And guess what happens? Their revenues aren't quite there for the diaper category, right? So that's something to keep in mind in regards to this. And obviously, people are really worried about revenue. Revenue growth, there's not going to be revenue growth for the next year, right? Unless a miracle happens. There's going to be no revenue growth because they're going to exit several product categories that are hurting their margins, that's hurting their profitability, right? And so they're getting out of those. So I understand if somebody's looking for revenue growth, they're looking at Honest and like, there's going to be no revenue growth for next year. I'm out. Peace. I get it. When there's revenue growth again, do you think Honest is going to be $2 a share? Nope, it's not. That's the thing. It would be so perfect if it was like, I'll wait till their revenue starts growing again in 27. I'll get back in this stock, right? Think it's going to be $2? It's not going to be $2 then. It's going to be $4 or $5, $6 then. Because more than likely what Carly and the team's going to show is even as their revenues are going down, likely their margins are, guess what? Going to go up. So as their margins go up and their profitability goes up despite revenue going down, once they get out of those businesses and exit the product categories that are hurting their margins and profitability, then people are going to start extrapolating numbers and going to be like, oh gosh, they're going to start turning revenue positive again in 27, right? And you've already got margins and profitability increasing with revenue going down. What do you think's going to happen when the revenue starts going up again? Oh my gosh. It's just math, ladies and gentlemen. And so, keep that in mind. The stock's $2 today. When revenue growth is there again for Honest, it won't be $2. It will not be $2. Okay. And so silly move in regards to Honest. And I understand it's a hated stock. No one wants a piece of that stock. We'll see in regards to that. I'll likely be buying Honest in the public account, more shares here soon. What did I buy here today? Okay. By the way, Discord chat's busy. We got a lot of members. Oh, look at that. We just got another new member. Now to 2,876 members. We got a new member just while I was recording this video. An all-time record today in terms of the most members in history. So what stocks did I buy? Here's what I bought. Here's why I bought them. Nike. First up, I bought almost $14,000 in Nike here today. Nike, I mean, it's easy money for the next 3 to 5 years. I don't know what other way to put it. Like, it's just, it's a tax loss harvesting situation. I wouldn't be surprised if Nike sees even more lows here at the end of the year. I wouldn't be shocked at all. Like, anybody that's bought Nike stock pretty much has lost money on the stock. So if you need a stock to write off some gains against, people sell Nike, right? And they're like, it's not going anywhere for the next few months anyways. I'll buy Nike back in the first quarter of next year or something like that, right? And I'll tax loss harvest for now, write that off against my gains. Easy peasy, lemon squeezy. Celsius Holdings, I mean, we just spoke about that one. That's a big boy buy today. I bought, $43,000 plus. When I say a stock should not have been down, and then I come through with the big dog money, that stock should not have been down, right? It'd be one thing if I said that. I'm like, that stock shouldn't have been down. And then I don't come and buy it. It's another thing when I come through with a $43,000 buy here today. It didn't deserve to be down. That was ridiculous, silly in regards to that. PayPal. Bought another 140 shares of PayPal. That was a little under a $10,000 move, $9,300 move there for PayPal. That one's, oh man, I think the returns for PayPal this next 3 years are going to be insane for that one, right? Yeah, I mean, my projections, have you guys seen my projections for PayPal? I think I have them saved here. Let me take a peek at PayPal. Lauder. Look at this. You guys ready for this? You ready? Here we go. So here is PayPal. This is my base case for PayPal. I have them only doing revenue growth of 7% on average the next few years. And guess what? My CAGR is likely going to be in the 20s for PayPal. And keep in mind, when we do these intermediate projections here, I'm not even factoring in for all the share buybacks they're going to be doing, right? Which is going to likely help that earnings per share be a lot higher than $7.33 in 2029. We could be talking about EPS of $8 to $10. With how many shares PayPal's constantly, you imagine how many shares PayPal's buying back right now with their cash flows that they have pouring in. My gosh, ladies and gentlemen. So I think PayPal's an easy CAGR in the 20s over the next few years, like easy. So yeah, I bought more of that stock here today. And I own a lot of shares in my different portfolios. Elf came through with a big boy buy for Elf here today. Like that stock should have been down. 5 to 15% would have been fair for Elf being down today, being that they missed revenue again. But 35%, like, what are you doing? Like, I can't, like, it's just crazy, man. Like, people are just so ridiculous with it. Like they sold Elf just a few months ago at 49, right? The stock was $49 just back in April. Does everybody remember Elf being $49 just a few months ago? Because it was. And guess what? It's 76 today, so you regret that massively. Let's go ahead and take a peek here at good old Elf on a shelf. Yeah, Elf got all the way down. I need to get this guy out of here. Elf got all the way down to $49 right there back in April, right? So, I mean, geez, you're already up, 54% from there. And that's with a stock crash. Keep that in mind. Like, oh my gosh. Jeez. Crazy. I don't know why I thought Chipotle. Next one up here, Cake. Cheesecake Factory. That was just a small buy for Cake here today, just 70 shares, $3,300 a Cake. And then Amazon. I love the Amazon stock. I would say, if I had to say what's the best stock to buy right now, before we get in the reaction videos, what's the best stock to buy in Mag 7 right now, today? The best buy out of all the Mag 7 stocks today for the next, let's call it 3 years, Meta, without question. Without question. With that being said, I have so many Meta shares coming out of my ears, it's ridiculous. So I always have to watch my risk levels, right? So being that Meta is such an oversized position for me, it's very difficult for me to buy more Meta shares, okay? What's the second best buy in all of Mag 7 after Meta? Amazon, without question. That's why I'm buying Amazon right now. I'm not overexposed to Amazon. I could still, between all my different portfolios, I could still probably add another $100,000 to $200,000, if not $250,000 of Amazon stock, and feel comfortable. For me to go buy another $100,000 to $250,000 of Meta stock at this stage with how many Meta shares I have, it's difficult. So remember, that's how I make it through the bear markets, right? I don't get too overexposed to any stock, because that keeps you, out of that situation. I can still outperform in a great bull market the way I position my portfolio. So I don't need to take some crazy risk and go all in a stock or something like that, right? Alrighty, let's react to some videos.
Here today, obviously, we've had a lot of discussion about how AI is driving things lower today. You're looking at the 50-day moving average. What's so important about what you're seeing right now?
Hey, Courtney. So, yeah, it's been a remarkable streak. We have not touched the 50-day moving average in 145 trading days. That's the third longest streak since 1990. The second longest streak ended in 2007 at 147 days. So we're quickly, coming up on the second longest streak in the modern era. And so that's the backdrop. Now, there's kind of two competing forces here. On the one hand, trend and momentum of the index of the S&P and the NASDAQ are quite strong. And we're in a seasonally bullish period when the market's in an uptrend. November, December tend to be even that much stronger. The issue is that under the surface, as many are aware, the internals are anything but robust. Last week, for instance, we had 9% of the S&P hit a 52-week low. And, the issue, you can have a market when there are a number of stocks underperforming on a relative basis, but when you start seeing absolute price weakness to the extent where, they hit a 52-week low, and let's be clear, 25% of the market is within 10% of a 52-week low. So there's really this bifurcation going on. And so that setup leads us to, at least at a very minimum test the 50-day moving average. But we think more likely you actually see something closer to 6,500 in the S&P before you see more fully washed out conditions.
Okay, let's talk some market now. Some big market talk. Where's the stock market headed, right? Where are the financial markets headed? Because obviously we just spoke about a lot of individual stocks there, okay? What have I warned you guys about consistently for the past 6 months? It's been something, if you watch my channel religiously, right? Something I've been warning you guys about for the last 6 months, time in and time again, right? What has it been? 2018. And watch out for the fourth quarter of this year, right? Is everybody watching out now? Is everybody listening? I warned everybody about this for 6 months. I don't know how many people listened, right? Again and again and again on this reaction channel, on the main channel, 1,000 times. Watch out for the fourth quarter of this year. Reminds me a lot of 2018. 2018 had a lot of pain for investors. Exactly what we're seeing. People are experiencing pain right now. I just pulled up Bitcoin. Bitcoin's down about 20% from its recent highs, right? We got a lot of these individual stocks getting slammed all over the place. Like I looked at how many stocks were down 15 to 35% today, and it was a long list of them. Did you guys see? I think I still actually have it up here. How many stocks were down? Like, look at this. Look at how many stocks were in severe pain today. Like, look at this. Like, there must have been, how many stocks were down, like, you know, let's call it 10% plus today. Look at this. We're talking, was that 40 stocks down double digit percentages today? That's an astonishing number. Jeez. So there's a lot of pain out there, right? But I warned everybody about that the whole year. Additionally, next up here, listen, this is another reason I pulled up Bitcoin here, okay? The other reason I pulled up Bitcoin is that's a very important asset to understand if people want to take risk or not. When Bitcoin is selling off, it's just the ultimate sign for people don't want to take risk. When people are bidding up Bitcoin, it's the ultimate sign of people want to take risk. They want to buy riskier stocks, right? Small cap stocks. When you see Bitcoin selling off, small cap stocks selling off, right? Which let's check out IWM. Okay, IWM, let's go ahead and take a peek at that one here over the past bit of time. So from where we hit those highs recently, the recent highs was right here, and IWM's down about 4.5%. So it's almost technically it's kind of in pullback area right now, that 3 to 5% range. It's kind of like a pullback. If it gets that 5 to 10% range, we'll talk about a big pullback. And then if it goes 10% plus, like 10% to 15%, we'll call that a small correction. And then if it goes, 15 to 20%, we'll call it like a medium correction. If it goes 20% plus, we'll call it a large correction, a severe correction, right? And so that's a sign that people are not looking to take risk right now. Now, the important other thing to understand about this and where the overall market's headed, when you see deterioration in Bitcoin, Ethereum, and smaller cap stocks, right? And then mid cap stocks, the last thing to fall before you can finally bottom out everything is the indexes have to get hit. That means S&P 500, and that means the NASDAQ. Once those get hit, then we can talk about eventually bottoming out the overall financial space and trending up from there. But it's a process, ladies and gentlemen. It's a process, and it goes step by step. And if you can look back at basically almost every kind of crash scenario, and it all plays out the same. And you could probably look back at April. You can look back at what happened in 2022 from the 2021 highs, right? At first, it was, Bitcoin started to get hit, Ethereum started to get hit, other crypto started to get hit, right? Small caps started getting hit, mid caps, and then it was the whole indexes. So just understand, there could be more pain ahead for this market in the short term meaning the next 2 months. I know November and December are usually great for the market. In 2018, they were not. That doesn't mean every year is great for the market in November, December, right? And so I've been, I obviously warned people again and again and again about there's, could be pain in fourth quarter this year. And now people are like, oh yeah, shoot, there was pain, right? But keep in mind, we could still get that indexes down quite substantially from here. We could see double digit percentages before year end, but a lot of that depends about what happens with government shutdowns, right? Does that end anytime sooner? Does that keep dragging on? The longer that drags on, the more the market's going to get freaked out here, right? So that's going to be a whole game at play. What happens between the US and China? That's a whole game. We got NVIDIA earnings on deck. That's a whole game. What news or not news do we hear about OpenAI? That's a whole game.
What about the put call ratio? I know you watch this one too.
Yeah, so look, the other issue, aside from breadth being much weaker than the index would have you to believe, is sentiment is quite complacent. So put call ratios are a good transactional indicator. You have survey data where you ask people, are you bullish and bearish? But the put call ratios are really, what are they actually doing? And they're bumping along year-to-date lows on a 5 and 20-day basis, meaning there's very little interest in hedging. And that's another concern. You can also see it in something like the National Association of Active Investment Managers. Their exposure last week hit 100, which was the highest since July of last year. So there's just a lot of indications that people are, certainly, if not euphoric or optimistic, at least complacent. And that's another market risk.
I really am always interested in consumer and market psychology. And Bitcoin has sort of been hovering around this $100,000 mark, which is a psychological level for people that watch this. What does it tell you when you look at it on the technicals?
Yeah, I mean, so two things. From a purely price standpoint, 110,000 was kind of our initial support, and that certainly broke. Obviously, 100,000, as you mentioned, is psychological. That is a level that.
I had a friend who bought a bunch of Bitcoin a couple of days ago, and I was telling him, he's kind of asking about what is potential downside, and I was telling him, here's how much downside based upon the stock market. And I told him, listen, if the NASDAQ goes down 10% between now and year end, I said Bitcoin's probably going to see the $75,000 level or maybe even under 70,000, right? If we saw the NASDAQ go down 10 to 15%, I said if the NASDAQ went down like 20%, you're talking Bitcoin probably down to 50,000, right? Why? Like, how do I have confidence in making a call like that? Because it always plays out that way. Like Bitcoin basically is like a 2x, 3x leverage on the Qs. It's just as simple as that. You can look back at almost literally any time period. People try to argue this. I'm like, this is factual. This isn't opinions. This is factual. Look back at 2022, right? NASDAQ was down 37% peak to trough, Q1 2021 to Q4 2022. How much did Bitcoin go down? 70%. And that's just consistent. Like look at just since the kind of recent highs we had, S&P 500 down 2.6%, IWM down 3.7%, Qs down 3.73% from the recent highs, right? And look at Bitcoin, 10% down. Look at Ethereum. Ethereum is basically like a call option, put option on Bitcoin, right? And look at Ethereum down 17% in that same amount of time, right? So you take those Qs down another 10 percentage points from here, you'll be talking about like literally Qs down 10% from here. You're talking about Bitcoin being down another like 25 to 30% from here. And you could be talking about Ethereum down 35 to 45% from here if you take those Qs down another 10 percentage points or so. So it's a simple game, man. It's a very, very simple game in regards to those assets.
People will be watching.
And it's not opinion. It's just like look at every single cycle and you see the same exact thing.
But, the reality is it just doesn't act well given what gold's been doing, given what the NASDAQ's been doing. And if you look over the last couple of years, there's a very tight correlation, or there has been, between Bitcoin and the NASDAQ. And, all correlations do break eventually. But I think, the relative weakness of Bitcoin was another red flag for us when coming into November looking at the NASDAQ.
And then very quickly, before you go, I want to dig into gold just a little bit more. It is down just a touch here today, but what a run gold has been on. Can you sort of tie it all together for us between what you're seeing with markets, Bitcoin, gold, and all those technicals? What does it mean? Is it really breaking from how we typically watch gold trade?
I think you can get, you can look at a lot of different ways to ask what gold means, but as far as what is the chart telling us? Mm-hmm. I mean, look, it got about 30% above its 200-day a few weeks ago. That's about the widest spread it's been in the last 20 years. So some consolidation was needed. It's had a little bit of it, but on a monthly basis, it's still very extended. So we think probably setting up for another leg lower, also likely testing its 50-day as many other markets are as well.
Yeah, so the bottom line is gold, market keeps going down, gold's going down too. A lot of people assume like, gold, NASDAQ goes down, gold's going to go up now. Sorry, it all goes down, You can even look at the great financial crisis. Like you would have assumed during that stock market crash where the indexes fell 50%, you would have assumed gold would have gone up, right? Because it's supposed to be a hedge and they announced all the money printing and whatnot during that crash. Check out gold over that time period. Yeah, no, everything was going down in Chinatown, oil, everything. Alrighty, let's react to this one.
Discuss TD Cowen senior retail analyst Oliver Chen. Oliver, it's great to have you here. And this is an interesting one because this stock had been on fire for a long time. It's sold in a number of retailers, and a number of retailers are having to go through some price adjustments. So can you explain to those that may not understand the particulars how that really did have an impact on the quarter?
Yeah, basically, Courtney, e.l.f. is raising the cost of their product by about $1. There was a slight disruption in terms of retailers taking a little more time to raise the price, and the company stopped deliveries to those retailers until they did raise the price. So that was an issue in terms of core ELF brand growth. And that is overall an issue, too, as core ELF brand is growing around 2 to 5%.
And listen, ladies and gentlemen, what is that? What is that he just said there, right? You know what that is? It's two things. One, power. e.l.f. has a lot of power. By them basically telling the retailers, we're not sending you product till you go, that's power. Not all brands can do that. But e.l.f., you don't have e.l.f., you're irrelevant. Your Target, your Walmart, your Amazon, you don't have e.l.f., Like, that's what the kids wear. Like, have you talked to the millennials? Have you talked to Gen Z? Like, okay, they're going to go somewhere else to get their elf products then at that point in time, because the best products for the price point you can get them at, right? And so like most of their cosmetics products are under $10 and they're high quality. Like customers love them. So that's very substantial in regards to that. The other point in regards to that is what? Guess what? Short term. It's a short term nonsense thing, right? Okay, it affected the numbers negative in this quarter. Who cares? If you're planning on owning Elf for the next 3, 5, 7, 10 years, it's irrelevant. Yeah, it hurt the short term numbers. Whoa. You know what I mean? Like, whoa. Oh gosh. We're screwed for the next 10 years because Elf didn't send some product to some retailers because the retailers were taking too long to, like, it's like, you won't even remember this. Like a year from now, you won't even remember this. Never mind 3 or 5 years from now. Give me a break.
In half. This is a brand, Courtney, that grew around 20% previously. So it's a very good company, and we are recommending the stock on a long-term basis, but expectations were high, and we thought expectations were high coming into this quarter, and growth has decelerated.
And so even though they're going to have to take these price increases, you don't believe that it's going to deter demand for this product. Obviously, this is a lower price product than some other makeup brands out there. This is more mass, less prestige.
Yeah, we see consumption trends as being quite attractive in terms of 7 to 10% in the market, but retailers are destocking and they're facing tough comparisons. So the reality of ELF core brand growth is moderating relative to the past, but it's still growing, and it's a very innovative company that reacts with speed. The stock is down a lot because expectations were very high, and this had grown a lot faster in the past. But the backdrop remains pretty good for beauty in the long term, given that it's a resilient industry.
Love to move on to Tapestry again.
Okay, so now you want to talk about a scenario where Elf stock becomes an absolute rocket ship. Short term meaning the next 3 months, and the stock goes from $70 to $120. You want to talk about that for a moment? How does that happen? I'll tell you exactly how that happens. There's a potential Trump tariffs could be overruled by the Supreme Court. Right? Potential. Might not happen. Might happen. We don't know. What happens if it is? One of the biggest beneficiaries in the entire stock market is Elf. Because they would see massive money coming back to them. And think about it like this, right? They're going up a dollar on all, pretty much across the board on their products. Let's say they don't have to start, pay that tariff anymore. Do you think they're going to go down $1 a product? Of course not. So then their margins would explode to sky high levels that we honestly haven't seen. So in that scenario, you would likely see Elf go from $70 to $120, and it would happen like that. You want to talk about Elf being up 20, 30% in a day, like it just was today? Have those tariffs get removed? There you go. So I'm not planning on that, but just understand, if you think you've got all the time in the world, like, oh, I could buy Elf for the $70 a year from now or something like that. We'll see about that. Next up here, let's talk about high net worth individuals, talk about what they're doing with their money, my perspectives on this.
That's Robert Frank. He's got the details.
Good to see you, Andrew.
Nice
Welcome
to see you,
back.
Sir.
Only a third of millionaires, in fact, surveyed use a wealth advisor, and among those who do, many are planning a change. A survey by Long Angle, that's the network of high net worth founders and executives, found that using an advisor does rise with wealth. So only 22% of those worth less than $5 million use an advisor, while nearly half of those worth more than $25 million use an advisor.
Do I personally use an advisor? No, I do not. I do not use a financial advisor. I have no interest in using a financial advisor, right? I can understand a lot of people wanting to use a financial advisor. It really depends on how much you trust your decision making, right? How much you know about the financial markets and emotions. It's not just about like, oh, I got to understand income statements, balance sheets, cash flow. Understand most financial advisors don't even have a clue how to properly value a company. They're financial advisors. I would describe them as very good for basic personal finance stuff, right? Like more income than expenses, like let's make sure we own some, index funds, things like that. Like maybe some tax related things, although financial advisors aren't even going to help you a lot. For most of them, they won't help you a lot with taxes. They're going to go ahead and send you off to a tax professional. I wouldn't be surprised if they get a fee on that as well, right? So, so some people, I understand them needing a financial advisor. Like imagine, you're married to somebody, they make a ton of money, they pass away, you don't know anything about money, right? Like, gosh, you should probably get a financial advisor in that situation. So you don't screw everything up. Or some people that maybe they gamble their money too much and they need somebody overlooking things, right? Or they just don't really care about money that much, but they came into a lot of money. Either they inherited the money or maybe they were just really successful at business, but they don't know that much about money. Like I understand those individuals using financial advisors, right? So a lot of it comes down to that, right? To each its own, right? For me no.
Them are considering switching advisors with most of the complaints around cost, a lack of personalized service.
The one thing I do as far as a professional, I do use a professional in regards to something money related. And you know what that is? Taxes. I outsource that to the professionals. I let the professionals handle my taxes. I've been doing that for years. I think I first started outsourcing my taxes to good professionals here in Vegas. I think I did that back in, like 2018. Like once I got to a certain net worth, which I will not describe, but once I got to that number, which was in 2018, I said, okay, I'm handing this off to somebody else, right? And that's when I went ahead and made that move. And ever since then, I've always used, professionals for taxes because you want to stay out of trouble with the IRS, right? Like I'm not trying to have any beef with them. I make sure everything's handled. The individual I use has actually a lot of authority at the IRS. And so, there's different levels of respect depending upon certain titles and certifications you have and your connections and things like that, right? So that's the one thing that I could honestly, everybody that's higher net worth, you should use a professional for your taxes. If you make, $60,000 a year and you got a net worth of $40,000, does it make sense to use a tax professional? Probably not. It could, but probably not. But if you get your income to six figures plus, if you get near net worth, certainly over $1 million, but certainly if you go to multi-millions, use a tax professional. Because remember, these tax laws are changing all the time. Every year when I finally have my meeting with them, they tell me about this thing changed, this thing changed, this thing changed, and now you can do this and blah, blah. I don't have time to keep, my focus needs to be on making money, right? That's where I can get the best ROI. Saving money on taxes, I'll outsource that. And usually the ROI you get from using a tax professional is going to be easily, especially if you're higher net worth or higher income, is going to easily be usually thousands or tens of thousands of dollars. And you're not going to pay them thousands or tens of thousands of dollars. So it's one of the best ROIs you can probably ever get, just to be honest. And in terms of peace of mind, right? Because let's say you get audited, you do your taxes yourself, right? And you got a multi-million-dollar net worth and you make, $250,000 a year, blah, 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 whatever, right? Ooh, when you get audited and you don't have a professional representing you who has some authority at the IRS, good luck.
Response times. Now, the survey also asked millionaires to rank 14 other professional services commonly used by the wealthy, from personal trainers to private schools, accountants, and estates attorneys. Personal trainers ranked highest on the satisfaction score with a 9.3 out of 10. Personal sports coach, private schools, sports coaches also got high satisfaction marks. Accountants and estate attorneys, though, they ranked below pool services. Therapy also ranked near the top.
Yeah, because one's like you just need it.
The other, like you need it, and the other one's like
you want it.
You want it, yeah. And in fact, when you look at therapy, this was an interesting one. Millionaires under 40 were 3 times as likely to use a therapist than those over 50. Now,
that's just generational, isn't it?
It's absolutely generational. Emotional health being a much more important issue for this group. You can find all the numbers and how much the wealthy are paying per year for all of these services. That was really interesting. How much they spend on private schools, private trainers, all that stuff. That's going to be in your
read this
newsletter coming out in the next hour. CNBC.com/Inside Wealth. You guys have personal trainers, right? You certainly look like
and I'm an emotional wreck, but I may need therapy.
Have you ever?
So, by the way, in regards to that, and it's a serious subject here, when it comes to like physical therapy, like personal trainer, right? I think that's a great thing for a lot of people if you get money. If you have trouble holding yourself accountable and you don't really know that much about working out, right? Like if let's say I never played football because I had an unbelievable strength and conditioning coach. I played football for 5 years, all 4 years of high school. An unbelievable strength and conditioning coach. He was so ahead of his time. Like I see professional athletes doing certain workouts that he had us doing back when I was in high school in like 2004, 2005. He was like, this guy, honestly, is a legend. Like in my eyes, his name was Coach Schmidt. Coach Schmidt, legend. I'm like, I see NFL players doing the workouts he had us doing back in the day. And I'm like, dude, this guy was so far ahead of his time. It's not even funny, right? And then I ran track. I was obviously a sprinter in college, right? So I know a ton about working out, like, about as much as you can know. And then I'm able to hold myself accountable. But I can tell you, if you don't have all that knowledge, and if you are a situation you have trouble holding yourself accountable, 100% get a personal trainer. It's well worth the money because they'll help hold you accountable, and they'll be able to, obviously teach you a lot if you don't know that much, right? And your physical health, your health is everything. You know what I mean? Like you could be a billionaire if you're in poor health. Oh gosh, you'd wish you'd have $100,000 to your name and be in good health, right? Like it's not worth it if you're in bad health. It's awful. And then in terms of, like therapists and things like that, yeah, if somebody's going through something or, has trouble dealing with something or whatever, like that's always a good option as well, right? But keep in mind with all this stuff, personal trainers, or if it's a therapist or something like that, right? Not everybody's created equal. You got to find really good ones. Same thing with taxes. You might assume every person that does taxes, they're all the same. They're not. They're not. You might assume all lawyers are the same. They're not, right? I always am willing to spend as much as it takes for top tier tax people, top tier lawyers whenever I need them for something. That's like, I get the best of the best. And I would do the same thing if I had a therapist. I would do the same thing if I had a personal trainer. I would get the best of the best, because at the end of the day, your results will go up significantly in any of those sorts of categories, right? So yeah, your health is everything.
Are you willing to cop
Sure.
that?
Years ago.
I have never, but I have 3 dogs.
Their therapy?
They're your therapy?
No therapist can come close.
You're highly satisfied with your dog therapy.
They're better than
10 out of 10.
They're better than we are. They are. We don't deserve them. We really don't.
After I joined the show, I thought I really got to get some therapy, right?
You know what?
But this is therapy, right? Is that what you're trying to suggest? I know this is therapy. 3 hours of therapy.
This is therapy, but I support your efforts to get additional therapy wholeheartedly. I'm not going to put you down for that.
Okay, I got one for Robert Frank that's just a curveball.
Yeah.
There are people in New York who I think the wealthy who might be looking for a therapist after yesterday's election. And more importantly, we're looking for therapy when they heard that Lena Khan was joining the transition team.
Which just goes to show you, looking back at the Biden administration, she had a very important job and we had her on all the time and hung on.
I think we should have her back and talk about what's going to happen in New York City.
But let's just know. Okay, so as long as we know, she is a
sure. No, but that's what I'm saying.
She was running a very important department.
Yes.
In the Biden
Think about it, Andrew.
I wonder what it portends for business in New York. It was funny.
It's great for business. It's awesome.
A number of business leaders in New York reached out to me yesterday. I was traveling back from London, and it wasn't even the election result itself. It was when this Lena Khan announcement was made.
Right.
It was like they were sort of like frozen in place, and talked. Some of the texting and back and forth was more about sort of what had happened to the merger business. Obviously there's a lot of bankers in this city, financiers in this city, and sort of what the approach is. I don't know if she's going to have a role in the future.
What can she do, though?
The future group or not?
What my question was, this appears to nationalize a city mayoral staff, right? Instead of saying we're going to operate the city as good managers, which is what the mayor's job is, it somehow makes it seem like we're going to be a platform for some national ideological.
I don't know. I was also surprised by that there were so many people from the de Blasio administration, of all things, and they were pointing to that as if, given that they have quote unquote experience. But the truth is, I think most New Yorkers, no matter what your politics, did not think that was a golden era. in terms of managing the city.
What is she going to do? What is her role? Did they say what her role is?
I could not ascertain that.
Yeah.
But I will work on it. I'd love to have her on the show, just talk about the future of New York.
Yeah, that would, yeah. If I had business in New York, I'd be scared as well. Like, oh boy, we'll see what happens with that. In regards to Linda Kahn specifically, right? And I don't mind it because I'm going to turn 36 here in just a bit. And my hope is in my 40s, I really want to get a place in New York City. I really do. I really love New York City. I do. Not as much as I love Vegas. Vegas is my number one, okay? But New York City, I love New York City. That's my number two, okay? And so I love to get a place in New York City, specifically at the Steinway Tower. So my hope is over the next 4 or 5 years, all the rich people start, moving out of there en masse, go down to Florida, right? And then I could get a place for cheap in New York City. And by then there'll be some new, people bringing back New York City. We're going to bring it back, okay? Pin comment down there to apply to your own private stock group, private wealth group, get access to thousandxstocks.com, all that good stuff. Alrighty, so public count up about $59,000 here today. A good day for the public count. This account's been in an absolute war recently. I mean, it's been battling with that $4 million line for like the past month or two. It'll go, 4.1 mil, maybe 4.2 mil. Then it goes back down to 3.8, 3.9. It's been an absolute battle. Meanwhile, people are still hitting all-time highs out there in their portfolios. Just last week, we had 4 people in the private stock group hit 7 figures, and we had 8 people hit 6 figures in their portfolio. So congratulations to everybody out there hitting new all-time highs in your portfolios. I obviously love to see it. Okay. We got a lot to get into in this video here today, ladies and gentlemen. Okay, Revolve stock was a huge mover for me here today, up double-digit percentages, up $4,800 on the stock, now up 100% on the stock in the public count. We're going to talk about Revolve, what's going on there with that company. Fubo moved up very nicely here today. That stock was up double-digit percent, up $8,000, up $36,000 on the stock now in the public count, over $4 a share. So we'll speak about Fubo, where that stock's headed from here. AMD, they wanted to send this one down. AMD. They wanted to send it down so bad. And yet that stock still found a way to be green, up $16,000+ on the stock here today, up $370,000 on that stock now at this point in time in the public count. We'll speak about AMD, where that stock's headed. SoFi, this one continues to show strength. Continues. It's unbelievable now, sitting at a 262% move, up $108,000. We'll speak about SoFi in this video here today. Shopify is my second biggest position in my Patreon portfolio, not the public account, but in the Patreon portfolio, right? I don't talk a lot about Shopify, but this one continues to move up. I want to speak about Shopify in this video as well. My gosh, do we have a lot to get into. Honest Company reported earnings. I got to share my opinions and perspectives on Honest earnings, what's going on there. There's a brand new stock I just bought for the first time ever. We're going to speak about that, why I'm buying that stock in this video here today. And then Elf earnings hit here today. That's been an amazing gainer for me over the years, sitting on a 1,500% gain on Elf stock. They had their earnings. I'm going to share my opinions and perspectives where that company's headed, where stock price is headed. Is this an opportunity? Is it not? Oh my gosh, ladies and gentlemen. I hope you enjoy this one here today. There's one thing, and there's one thing only I need from you. If you could please just hit that like button. And for every single person that's already done that, you are my hero. That's all I ask for today's payment. Okay, just a thumbs up. Okay, if you want to be subscribed here to the channel, you can certainly subscribe. We are well over 900,000 subscribers here on the channel now at this point in time. For the pinned comment down there today, I'm going to put the application if you're looking to apply to join my private stock group, private wealth group, all that good stuff. Remember, January 1st, we're moving to $100,000 minimum net worth to join in there. So if you're under 100K net worth, you might want to get in there before January 1st. And also, we have our new lifetime membership card for anybody that joins on a lifetime membership. Usually just get your Steel membership card for 1000X and your private group Steel membership card. But now if you're a lifetime member, you get the black card as well. So do keep that in mind. And then we're now up to 2,849 members of the private group. So I'm thinking about potentially closing the private group to new members when we hit 3,000 and then opening it back up at some point in time in, let's call it 2026. The demand's been overwhelming in there. Just yesterday, we received another 100 applications after receiving 500 applications last week. It's been ridiculous. So that's going on there. Pinned comment down there if you're looking to join us in there. Okay. Already, Revolve. Okay, here we go, ladies and gentlemen. Man, do we got a lot to go through in this one here today. Okay, listen. In regards to Revolve, this is very important. I do not talk a lot about this company, but listen. This is a company in the e-commerce space, very successful selling clothes. Okay, and we can call it $300-ish average orders. And so very heavy female demographic as well. And this is a company where, they were kind of a dead stock. Then they were a beautiful stock. Then we went through inflation and all the drama in 2022, 2023, right? That really brought down this company. But man, the company finds a way to just execute. Their net sales were up 4% year over year for this company, even despite everything going on out there in the world, right? Gross profit was up 11%. And net income was up 97%. I put this in the private group. I said, I love to see my company's revenue growing, gross profit dollar growing even at a faster clip, and net income growing even faster than that. And that's exactly what we have with Revolve here, okay? Remember, Revolve has one of the best balance sheets in the entire world, ladies and gentlemen, in the entire world. Phenomenal balance sheet of this company, and it's a very small cap company too. It's not like this is some massive company. This is about a $1.5 billion market cap, and they have over $300 million of cash and cash equivalents on that balance sheet. And it's incredible. $251 million of total assets versus $291 million in total liabilities. The income statement looks great for this company overall. So Revolve is a very good company with a good management team, and they continue to execute and come in through with numbers. And so there's brighter days ahead for Revolve, and I can see why it had momentum today. It's a stock I'm happy to be a shareholder of. And their income statement was really good. I didn't include it in here. I have it in the private group, in terms of the grade and whatnot, but it was a good grade. It was impressive, man. Very, very impressive overall. I think I graded them a B+, if I recall, for Revolve. So really good company. I don't talk about it a lot. It is a stock I own, and it's a good company. Doubled up with my money on it, and I wouldn't be surprised if I end up tripling up, quadrupling up my money on that stock over the next few years. Okay. Fubo, next one up here. This is a speculative stock I have. That this stock continues to get less and less speculative as I've owned it over time. Obviously broke the $4 barrier here today, and now up over 80% on the stock. I think this is the next stock in the public count to basically get us a triple-digit gain. Revolve is the seventh stock in the public account to an active position to be up 100% plus on. I think Fubo's next up. I think that will be my eighth stock with a triple digit gain or more that's an active position in the public account. Okay. So here's the deal with Fubo. Okay. I don't know if you guys got to see my AMD video on the reaction channel last night called Jeremy Lefebvre Makes Money. But that video, I reacted to Alex Karp interview. I reacted to a Tom Lee clip. And obviously, I spoke in depth about AMD's earnings and my feelings and those sorts of things. But in that video, I threw in Fubo as well. Okay, so that's why you always want to make sure you watch my videos. I'm going to throw other subjects in outside of just whatever the main title is, right? And basically, in that video, I said, you know what I said? I said, it's a crime that stock is under $5. I'm talking about Fubo, right? It's an absolute crime. The way that company's executing, there's no way that stock should be under $5. We could debate whether it should be $5 or $7 or $10 or $12 or $15. That's a free debate. But I do not think there's any way you can justify that stock being under $5. Given the deals gone through now, given the balance sheet, the connections with Disney, I'm just no. There's no way conceivable that stock should be under $5 right now. So, don't be surprised if you see that one over 5 sooner rather than later in regards to that stock. And the bottom line is it's less speculative than it's ever been in the company's history, right? And so it doesn't belong in the gulag. It does not belong in the gulag, okay? AMD. So AMD, they wanted to send this one down. They couldn't send it down. AMD remains a very resilient, strong stock. One of the strongest stocks in the market, despite everything going on out there. AMD holds up very, very well. And it's really because of what this company has coming over the next few years, right? When I put my bull case, base case, and bear case together, my bull case, usually I would put it a 10% probability, something around my bull case happens. Base case, I put around an 80% probability, something like that happens. And my bear case, around a 10% probability, something happens, right? Look at this bull case for AMD, okay? In my bull case for AMD, I have them growing 40% revenues per year. Keep in mind, 2026 to 2029, I would say all their business lines should be growing. Every single business line they have. But the data center business is going to be insane. Because that MI400 series, which really that 450 series goes into production late next year, right? Well, second half of next year, that's going to be a blow off top for the business. And that's going to run all the way through into 27 and likely into 28 as well, right? So in my bull case, I had them growing 40% revenues, 50% net income. That puts the stock, you know where it puts it in 2029? At an $845 stock to $1,100 stock. Smoking. What about my base case for AMD? This is what I expect. So this is just a fancy way of saying like AMD's numbers will likely be somewhere around what I have here for my base case, in my opinion, at least, right? And then doing 35% revenue growth on average, 26 to 29, 45% net income growth on average, 26 to 29. I have that stock going $670 to $800, right? Which gives me a strong compounded annual growth rate of probably around 30%. This, ladies and gentlemen, is why I built AMD into one of my biggest positions. And this, ladies and gentlemen, is why you're seeing momentum in this stock continue. Because if my base case comes true here, right, how many other stocks in the market over the next 4 years are going to give you a compounded annual growth rate well into the 20s, if not 30% plus in a realistic base case? There's not many, if any. That's a one of one. So that's why that stock continues to see momentum despite the market, despite sell-offs and AI fear and bubble and this and that. Like AMD's a one-on-one story and a one-on-one situation going on. And the story just gets better and better. That's the best thing. Like the story's better now than it certainly was a year ago. And guess what? The story a year from now is going to be dramatically better than it is right now. So, and then its story even a year from that will be even better. So that's the beautiful thing with AMD. Now, my 10% probability of bear case, if things went really bad for AMD, right? Basically the stock would be a money loser between now and 2029. But that case has them growing revenue at only 20% clip per year, which I don't see that. Like with how much demand there's going to be for that 450 series, I just don't see that being realistic at all, right? But it could be a dead stock for 4 years if they didn't grow strong, right? But I think 35% revenue growth on average should be very realistic for this company overall, right? Next one up here, SoFi. SoFi stock continues to see momentum time and time again, right? And this is one you think would be a pullback. You see some Russell weakness out there from time to time. You see like overall fears of this, fears of that, fears around even like a lot of these hot stocks that have been hot, right? Like margin calls coming for retail investors and all this stuff, right? And at the end of the day, SoFi continues to just show strength and strength and strength, right? And for all of us that were buying the stock back when it was a single digit stock, like just a year ago, we've made great money. Congratulations to everybody out there, right? But here's the deal. If you want to, like, I think my personal opinion is SoFi is the most exciting company in FinTech, period. Now, if you look over the past year, you would say Robinhood is the most exciting company in FinTech. And I would say over the past year, that's a fair statement, right? But you got to understand in regards to Hood, and this is no shots at Hood, this is no hate at Hood, right? But somebody's got to be the most exciting, right? And I think we've really flipped here on what stock is the most exciting in FinTech and could provide the best returns moving forward, right? The thing with Hood is, Hood over the past year has really benefited from the massive amount of retail investors that have gotten in the market. We've seen margin go through the roof, right? Bitcoin obviously went on a huge run. Now we see stocks kind of weakening, right? We see Bitcoin certainly has weakened dramatically, and margin levels are probably topping out right now, at least for a period of time. And how does Robinhood make a lot of money? They make a lot of money from people buying and selling a lot of stocks in Bitcoin and Ethereum and margin, all those sorts of things, right? So now we're in a period where we feel like we're kind of flattening that out, right? And so that makes it a little bit tougher of a position. And so what we witnessed over the past month, you see that 1 year is insane, right? Here's the 1 month for Hood versus SoFi. Over the past month, Hood's down 3%. Now that does not include Hood is down after hours right now as well. Do keep that in mind. So Hood's return could be less than this. But I was just taking it from where it was at today. 3% down in the past month versus SoFi is up 18%. We've had a huge flip there, and it's kind of a changing of the guard in terms of what's the most exciting FinTech and which one, or people really want to be in over the next year or next 2 years and things like that, right? SoFi is much less reliant on stocks and crypto and stuff like that. They're much more reliant on traditional banking and attracting those sorts of customers, which are extremely valuable customers. And that's not to say Robinhood's customers are not, important as well. It's just, it's a different level of importance with your customers when your customer base has a bank accounts, right? When your customer base is taking out a home loan, a car loan, a personal loan, like that's a different customer relationship there. And there's a reason, JP Morgan is $1 trillion giant, right? And Fidelity's not. Like Fidelity Investments, I love Fidelity Investments. They've grown into such a giant, beautiful company. But at the end of the day, there's one JP Morgan. And, so keep in mind who could be bigger long-term. Don't be surprised if SoFi is a larger company long term. If Anthony Noto executes the way I think he can over the next 5-10 years, you could actually see SoFi actually be a bigger company than Hood. And that would be kind of shocking to people right now because people don't even, couldn't even conceive that being a possibility, right? Oh, we'll see. Okay. Now, in terms of Shopify, this is the second biggest position for me in my Patreon portfolio. Almost a 10% position. I don't talk about Shopify a lot, but it's been a great performer, up 146%. In the Patreon portfolio, one of my better stocks out there in the Patreon portfolio. Here's the deal with Shopify. And honestly, this is a stock that I feel like there's two companies that almost everybody should own. One is Amazon, one is Shopify, right? I could make strong arguments that everybody should own either Meta or Google or both as well. Okay. Like those to be like non-negotiable. You got to own Meta. You got to own Google. You got to own Amazon. You got to own Shopify. Okay. So here's the deal with Shopify. They just grew revenue 32% year over year. They've done now 1.4 trillion in global commerce since Shopify came about. No one ever even heard of Shopify 10 years ago. It's incredible, right? Around 12% US e-commerce market share. Now they're available to millions of merchants in 175 plus countries. Obviously, they have a ton of small businesses and mid-sized businesses that use Shopify, right? We know that's a place Shopify really dominates. Small businesses, mid-sized businesses, but a lot of large companies now are creating Shopify as their back end as well, including two companies I personally own. Elf, which we're going to talk about in this video here today, and Estee Lauder. Both of those did deals with Shopify. So keep in mind, Shopify is the company for not only small businesses, not only mid-sized businesses, but large companies as well. And they're continuing to land more and more. And don't be surprised if that continues to build over the next several years. Now, when it comes to Shopify's income statement here, a little bit of a mixed bag. That's why I gave them a B- here. Great revenue growth, obviously, from the company, 2.1 billion to 2.8 billion. Remember, this is an asset-light company. So keep in mind the revenues will always look a lot smaller than somebody that's asset-heavy, like let's say Walmart. Somebody that's asset-heavy like Amazon, for instance. Those companies' revenues are going to be crazy. Shopify is more of a software play and much more of the best way I could put it is just it's asset light. Okay. So their revenues are never going to be the type of big numbers that you're like, oh my gosh, like Amazon could do, $200 billion of revenue in a quarter, right? That's not going to be Shopify. But Shopify, what they could do is long-term be ridiculously profitable and be able to throw billions of dollars a quarter off in basically net income long-term, right? So great revenue growth, 30% plus for the company. Gross profit went to right around $1.4 billion from $1.1 billion. Merchant Solutions was a little high as far as that cost of revenues there. That was, we can call that growth of what? 35, 40%, somewhere in there roughly. Sales and marketing went up quite a bit, 410 mil versus 331. Transaction and loan losses here. That was a big increase year over year. $148 million. Oof. From $58 million. So that definitely hurt the operating expense line item. So operating expenses went to a little over $1 billion from $800 million in the same quarter last year. Even despite that, operating income still increased to 343 mil from 283 mil. They had a one-off last year that made their net income look way better than it was essentially. They did not have that in this particular quarter. So net income, excluding the impact of equity investments, $367 million for the company overall. The thing you got to understand about Shopify is Shopify doesn't get talked about in the same sentence as many of the Mag 7s, right? NVIDIA, Apple, Microsoft, Google, Amazon, Meta, Tesla, those sorts of companies, right? But you actually look at this company since it went IPO about 10 years ago, and it's actually outperformed almost all of them except NVIDIA. NVIDIA is the big dog, right? Over the past roughly 10 years since Shopify went IPO, NVIDIA's stock is up a shocking 35,000%. Okay. But you know how much Shopify's up? A very impressive 5,800%. 5,800%. Tesla, which you would think has been, up there with Shopify, it's actually not. Tesla's up about 2,600% over that time. Amazon's up a little over 1,000%. Microsoft's up about 1,000% as well. Google's up a little under 1,000%, and then Apple and Meta are in the 700% range, right? So Shopify doesn't get talked about that much, man, but it should be. It honestly should be. Speaking about honest, there's honest. Okay, let's talk a little honest. What's going on here with this company? Alrighty. So this one's a complicated one, okay? Because they've got a lot of changes going on with their business model. We'll talk about here in just a moment. I graded them a C- for their income statement over here. Revenue went to $92 million from $99 million. Cost of revenue fell about $2 million year over year. So you wanted to see that number down bigger than that, considering the revenue being down, right? Gross profit, $34 million versus $38 million. Selling general administrative, this was actually very impressive. They brought that number down substantially. That was $23 million in the same quarter last year. They brought it down to $17 million. So if your revenues are going to go down, you better bring your SG&A down considerably, right? Marketing, though, I didn't like to see that marketing line item. That was up quite a bit year over year from $13.1 million to $14.7 million, right? I didn't like seeing that. And the reason being is revenue didn't grow in the quarter. I don't want to see my companies having revenue shrink, but your marketing expense went up. Okay, if they would have brought marketing down a lot, then I would have said, okay, fair play, right? Then maybe that's why their revenue was down. So total operating expenses, it did fall for the company year over year. So they actually were able to increase operating income despite revenue being down, we can call it, close to $7 million year over year. That's actually pretty rare. And with all the tariffs going on and all that drama, like it's actually pretty impressive that they were able to grow their operating income despite revenue being down almost $7 million, despite the tariffs and all that drama, right? So diluted EPS grew on a year-over-year basis, net income grew on a year-over-year basis, but, kind of small numbers there, right? Balance sheet looks amazing, $71 million plus in cash and cash equivalents. They have more, this is insane for honest. They have more in cash and cash equivalents than their entire total liabilities. You almost never see that with a company. It's extremely rare for you to see a company with, they have $20 million more in cash and cash equivalents than if their entire total liabilities put together. Ridiculous. Like, Honest is the strongest, this is like a $300 million market cap, a little over $300 million market cap, right? When they're sitting on that sort of cash level in this sort of balance sheet at a $300-ish million market cap, that's ridiculous, man. A one-on-one balance sheet for this company, no doubt, right? No, they're doing some major changes to their business model. It's called Transformation 2.0 with the company. Keep in mind, Transformation 1.0 went phenomenal. Like Carla, in the team has, basically transformed this business from a dead company, a company that looked like they were going to go bankrupt, into now a company that we talk about the balance sheet being like legendary balance sheet, talking about a company that's now profitable, right? Has margins stable, all those sorts of things. So now they're taking things to the next phase, Transformation 2.0. The revenue for product categories or channels that they're exiting, right, are accounted for 22 to 21% respectively of their revenue for the 3 and 9 months ended September 30th. So basically they're going to be getting out of some products, right, that are likely taking the company's focus away from other products that could actually be game changers. There's probably some products, this is my guess here, okay? There's probably some products that Honest is selling right now that are not bringing any profitability, or maybe even arguably losing the company money, right? And are hurting the margins substantially. When they could just get out, and it's a tough position to be in if you're Carla, right? Because you're looking and you're like, okay, if I get out of these businesses that are drags in the business from a margin perspective and profitability perspective, right, I could likely set the company up for a much better next 5 and 10 years, right? But there's short-term pain you have to go through over the next 12 months because your revenues are going to go down. Like, there's no disputing that. Like, it's pretty much impossible for the revenues to go up when you're getting out of several product categories that are big product categories for you, right? And so something to just keep in mind here is revenue is not going to be exciting at Honest for the next year, basically. They're going to have downtrending revenues for a year. But with that being said, the business is likely going to get a lot healthier. And what they're going to build out into after that essentially is a company where margins could go to records that we've never seen in this company's history since they've been a public company. We could see that net income and the earnings per share go to numbers that we never thought possible, right? And this is going to allow them to put more resources behind the products that actually have real potential to really grow this business substantially in terms of revenues, in terms of profitability and things like that, right? My guess is they're going to lean heavier on cosmetics, beauty products, right? Maybe their core baby business and things like that. That's my guess. And maybe they're going to exit some other product categories that just, or certain products in product categories that just aren't moving volume, right? And are just distracting the company, taking their margins down, taking their profitability down, right? And then you got to have employees that help run it. And at the end of the day, it doesn't make sense, right? Like, you could have revenue just for revenue, but at the end of the day, if you're just growing revenue for revenue's sake, it doesn't make sense, right? So the deal is, I don't know where the stock will be at tomorrow, but maybe it'll be at like a $330 million market cap or so, right? I think what Carla is doing here, I think one, she's making these moves because it's likely going to position Honest much better for the next 3, 5, 7 years. But the other strategic thing she could be doing here, ladies and gentlemen, okay, I've been in this market 17 years. I've seen a lot of things, okay? She could be positioning the company to eventually sell this to a big company, okay? I don't know who. Do they want to sell it to a Kimberly-Clark? I don't know. Kimberly-Clark just did that Kenvue deal. I'm not sure about that. Do they want to sell it to a Procter & Gamble over time, or a Johnson & Johnson, or whoever, right? There's a lot of different options out there. Maybe they could even go to like a private equity fund or something like that. There's always a potential that maybe Carla and the team want to sell the business, right? And so if they do that, they want to position the operations to be as lean and profitable as possible. Because if you're coming in to buy Honest, let's say, right? And you're coming in thinking you're going to pay $500 million or $700 million for the company. One, you want a clean balance sheet. Then it makes it a lot easier to sell the company if you got a clean balance sheet. Honest is debt free and they get loaded with cash to the sky. So let's say you pay $500 million for Honest, $700 million, whatever, right? You're also then getting $70 million back in cash. Now, assuming it's 1 to 2 years in the future, the cash level will probably be even bigger, right? Who knows what their cash levels are there? Maybe it's $80 million or $100 million. So you're actually technically paying way less than whatever the dollar amount you announce is, right? And you're not having to worry about, oh crap, we have to take a big debt load on at high interest rates, right? And then you could also grow your company's revenues and then get into a lot of these product categories that Honest is very successful in, selling to a lot of the millennials, Gen Z and things like that, right? So she could be positioning the company for that and maybe an exit, right? Which, she would make everybody a lot of money in the end. Like if she did sell this company, let's say they sold it, a year or two from now for like $700 million or whatever, she would make herself a lot of money. She'd make all the other executives a lot of money, and she'd make obviously shareholders like me and maybe some others a lot of money. But that might not be the route. Like maybe her ambitions are really to grow this to be $1 billion company or a multi-billion-dollar company long term, right? That could be her ambition as well. But regardless, whatever she's going to try to pull off here, it's better to position the company the way she's positioned it, right? So just don't be excited about Honest's revenues for the next, 4 quarters. Honest's revenues are going to, suck for the next 4 quarters. But that doesn't mean profitability will suck, and that doesn't mean margins will suck. So do keep that in mind, okay? And in terms of me, I have full trust in Carla making this move. Full trust. Like seeing she took this company from they were on their way to bankruptcy, it was a $1 stock, to seeing to where it's at now with his balance sheet, with the income statement, they're profitable, they have money to the sky. Like I trust her. I trust her in regards to this, right? Alrighty, next up here, new stock I just bought. First time ever. What stock do you think it is? Think it's Pepsi? No, it's not Pepsi, okay? You know what it is? It's going to surprise some of you guys. You're going to be like, what? That stock? Interesting. It's what it is. American Express. Ticker symbol AXP. It's a $365 stock here today. I've started a position in the public account. I've also started a position in at least one of my private portfolios, if I recall, if not 2 of my private portfolios now at this point in time, okay? So, American Express, I love this stock, okay? Obviously, we all know American Express. Like, if you're watching this right now, I'll almost guarantee you 98% of people watching this right now, you've heard of American Express, if not 99%, right? Credit card company, they make the fees, right? Additionally, you pay fees to American Express and they give you a bunch of perks and features and things like that. Incredibly successful business, right? And, if you're higher income, higher net worth, good chance you use American Express, right? So American Express, here are my numbers for this company, right? Other than a 10% revenue growth under my bull case, right? 10% probability this plays out, 15% net income growth. If that happens, the stock goes to $800 to, let's call it $950 by 2029, right? Or in 2029, which right now a $365 stock, that's a very strong 20% plus CAGR here, right? My 8% probability base case here, this has them growing revenues at 8% per year on average, 2026 to 2029, 12% net income growth, right? 28 to 33 PE, which would be very fair for a sticky business model like this. And that would put the stock somewhere just under $700 to potentially $800 come 2029, right? Keep in mind, American Express buys back a ton of shares. So what you're not seeing in these intermediate projections is they bring down the share count substantially over the next 4 years, right? Which makes their earnings per share go up at a way faster clip than, let's say, 12%. Maybe it goes up at 15%, 20% clip a year, right? On average, which then you can say maybe the stock price might go more towards $700 to $900 in that scenario. Something to keep in mind here, okay? And then even under my bear case scenarios, guess what happens? I make money. I mean, even under my bear case, only 5% revenue growth and only 8% net income growth, which would be bad for Amex to do this over the next 4 years. Even under that scenario, I get a compounded annual growth rate of 4 to 10%. When I can run numbers on a company and I'm going to get my base case around a 20% CAGR, and I can run a bear case and I still make money, I can't sit on my hands and not buy that stock, because there's not a lot of companies that's possible with, right? I even ran you through AMD. AMD's, got so much upside potential, right? But in AMD, my bear case has me losing money. So it's more of a risk. When I run numbers on an American Express and I make massive returns under my bull case, I make 20% type CAGR under my base case, and then I still make money under my bear case, I'm going to buy that stock. And that's why I've started a position in American Express, because I'm just like, the stock is too attractively priced right now. Additionally, American Express pays a quarterly dividend every 3 months to everybody. Okay. Look at American Express's revenue over time, right? That's the type of revenue growth you want from a company. Obviously, the really big growth here was coming back of travel, right? Travel coming back. But this is where we're at right now. That's what I love to see from a company, right? Trailing 12-month earnings per share. Look at that, baby. That's where we're at right now. This is where we're headed under that earnings per share growth. Shareholder equity continues to increase for this company, and look at shares outstanding. Remember, American Express produces unbelievable cash flows, right? Unbelievable cash flows. Such a profitable business model, and just gets more profitable every year. What do you do if you're American Express? You got all this money pouring in all the time. You might do a tuck-in acquisition here or there, but you're not going to do some massive acquisition, because a lot of times the government's blocked that. It's not like American Express could say, I want to go buy MasterCard or something like that. Like, it would get blocked, right? Or we're going to go combine with Visa. Like, no. So what do you do with all your money? You do share buybacks with them. And so what American Express is doing is they're basically keep compressing the amount of shares outstanding and keep bringing it down and bringing it down. And I honestly don't see that slowing or stopping anytime soon. And as a company gets more and more profitable, guess what? They're going to be able to buy more shares back, more shares back, more shares back, right? And so it's just a beautiful situation with American Express. And sometimes you just need to own a stock that's just stress-free, and you're going to be able to make a lot of money. And that's American Express, right? I had a fancy AI, Google Gemini, make this photo for me, this guy looking at the ocean. And that's American Express shareholders right there. Like, you just make money and make money and make money and make money. And it's just sometimes like those stress-free stocks. Is American Express the most exciting, sexiest stock in the market? Oh my gosh. Oh, they're going to Mars. They're going to go mine on Mars, and they're going to mine in the ocean. They're going to pull out rare minerals. No. Okay. No. But at the end of the day, it's a huge moneymaker. And at the end of the day, if you get an opportunity to make a lot of money in a stock, take low risk, you got to take that opportunity. And that's just what it is with American Express. So I could continue to buy American Express on and off for years to go in the future. It's not like this is like, oh, I just got to buy it this month. I could buy the stock on and off for years to go in the future and feel very comfortable holding that stock. Okay. Next up here, Elf on a shelf, or shall we call it Elf fell off a shelf? Maybe. Okay. Something like that. Okay. So Elf, what's going on here? Okay. D grade income statement for Elf here. Not good. Okay. Revenues look good. Net sales up to 343 mil from 301 mil, right? Gross profit went to 238 mil from 214. SG&A increased dramatically year over year for the company, 231 mil versus 186 mil. Operating income went down to $7.7 million from $28 million the same quarter last year, right? Also, they had an other expense in the quarter of almost $2 million versus the previous year's quarter. They had a other income, basically of $3.8 million. They're just getting hit by everything. Interest expense hit them hard, $9.1 million interest expense versus $3.7 million. Net income fell to $3 million from $19 million. Diluted EPS fell to 5 cents from 33 cents. So it was just like, I don't want to say everything that was going wrong could have gone wrong for Elf, because if everything truly went wrong, revenue and gross profit would have went down as well. The only reason this company snuck out with a D grade is because that net sales grew and because gross profit grew. If it wasn't for that, this would have maybe been an F grade-ish income statement here, because the expenses they were getting hit by everything in this quarter, right? No, they put out their latest guidance number, all right? And for the fiscal 2026, which they're now moving into. And they're guiding for 18 to 20% revenue growth. Now, some people are looking at that and they're like, that's it? They're like, that's it? Elf going up on price of the products, right? We know sell-through is very strong. They have international expansion. And additionally, they're going to have a full year of the Rode acquisition. So people are looking at that and like 18 to 20%, like we were hoping for more. Like we were hoping for 25 or 35% or 30% or something like that, right? Only 19% at the midpoint? I don't know. Like, we wanted more than that. And I can completely understand that, but you got to understand something deeper here that's going on, okay? Listen, Elf just missed revenue estimates the second quarter in a row, okay? That's not good. Terang doesn't ever like to miss revenue estimates, and he just missed them twice in a row, okay? They missed this quarter by $21 million, and they missed last quarter by a very slight amount, okay? Now, look at prior to these last two quarters. Beat on revenue. Beat. Look at how many quarters. How many quarters did they beat revenue in a row? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. At least 19 quarters in a row. At least 19 quarters in a row they had beat revenue. And now they missed it 2 straight quarters. So if you're Terang and you're the management team, you're a CFO, you think you're going to come in and put some big number to potentially end up missing in the end? No. You're going to put out a number that you're extremely confident, regardless of what Trump does and the tariffs and the blah, 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 and the government shutdown, regardless of everything in the world going on, you're going to come in and beat that number. That's what type of number you're going to put out there, right? Because we know Terang and the team, they like to beat numbers. They don't like to miss. It's embarrassing for them to miss, and they missed 2 straight quarters, right? So that's what's going on there, okay? Now, so basically the moral of the story is I think they're going to do way better revenue growth than what they posted. 19% midpoint, they'll probably blow that away, okay? We'll see. Maybe they don't. Maybe they just keep missing revenue. Maybe Elf's done. They just miss forever and ever. I don't think that's the scenario, okay? Next thing you got to understand is a little bit deeper about Elf stock, okay? It's very important everybody understands this. Listen. Elf stock is one of the most volatile stocks you'll see in the stock market. And it's kind of confusing because it's a cosmetics company, beauty company, and you're looking at it and you're like, how could this company be this volatile, right? This company goes IPO kind of toward the end of 2016, right? IPO somewhere very shortly after in the $20 to $30 range, high 20s to low $30 range, right? You know what happens over the next couple of years? The stock goes to $7. That's when Jeremy Lefebvre steps in and buys it, right? I still have my $7 shares in the public account today, right? Then the stock goes on to 2x, over 2x, essentially. It goes on an epic run all the way up to, $15 to $20 a share. Massive run. Then you know what happened after that? Elf stock crashed all the way down to about $10 in the Rona crash. You know what happened after that? Stock skyrocketed over the next year or two, all the way up to $30 a share. You know what happened after that? Stock crashed all the way down to $20. You know what happened after that? Stock went on a historic run from $20 to $200 over a couple year span. You know what happened after that? Stock crashed all the way to $49, which is where it was at in the Rona, or in the, not the Rona lows, in the 2025 lows of this year back in April. Go look at Elf stock. It was at like $49 a share at the lows, somewhere in there roughly, right? So it goes from 200 down to 50. Then it bounces strong all the way up to 150. And now the stock crashed again. And I don't know, after hours, it's somewhere between $90 and $100. But what can you take away from this? Okay, what can you take away from this, ladies and gentlemen, from this company? It crashes a lot. It skyrockets a lot. But guess where it goes over the long term? Up into the right. Terang runs this company on a phenomenal level, and it goes up into the right. And so this crash that we're going through now, right? In the end, it's not going to matter. Just as we don't think about the $20 crash anymore, or when it crashed to 7, or when it crashed to 10, right? Or when it crashed earlier this year to 49. It all just becomes a kind of a blip on the radar. Because at the end of the day, if Elf really executes on a high level in this company over the next 3 to 5 years, the company is likely going to be a $300 to $500 stock. They're going to become a cosmetics giant. Cosmetics giant, as in one of the biggest companies in the world over this next 5 to 10 years in the cosmetic space. Like, they have a great opportunity for that, to displace some of the biggest brands in the world, right? And so it is what it is, man. Like, as far as the stock in the short term, like, it's just another one. Like, I've been in the stock for years. This is all the way back when I bought, right? Look at how many crashes I've been through. Never mind all the corrections that you hardly even see now on this, right? Remember all these corrections the stock has had? Like, countless corrections. Some were severe corrections, and then had a multitude of crashes. Look at how many have happened over the years. I've dealt with at least 4 now. I've dealt with at least 4 crashes in ELF stock now since I got into stock, years ago. And I've dealt with 20 corrections in the stock and probably 50 pullbacks in the stock, whatever. It is what it is in regards to that, right? Now, this is a message I gave the private stock group yesterday, right? I said some noobs are already worried and scared with the NASDAQ down 2 to 3% from all-time highs. So imagine we get a 10 to 15% drawdown. They'll be in full-blown panic mode. Some folks would never make it through Q4 2021 to Q4 2022 drawdown of 37% in the NASDAQ, right? Only the strongest survive. The thing you got to understand is, and I think this is a great time to talk about this, right? Because I looked after hours and I was like, man, stocks are just getting obliterated all over the place. Like Pinterest, I think, was down 20+%. Duolingo was down 20%. Robinhood was down. Obviously, Honest stock was down over 10%. Elf stock was down 20%. And so I was like, in the market, right? You got to understand you're going to go through some very severe crashes, corrections. Some are going to be in the whole market. Some are going to be in your individual stocks. Diversification matters significantly. So if you have, because sometimes there's going to be some stocks in your portfolio that just suck. They're just not working out. That does not mean that was a bad investment. That doesn't mean they're not going to work out over the next few years, but they might be going through something short term that you didn't foresee it being that bad, right? And you can't bat 100% in this game. You're going to be wrong sometimes. You're going to be wrong about the short term of your company's businesses sometimes. Sometimes you're going to be wrong about the long term. And you'll hold a stock for 3 or 5 years, not make money on it, and realize it was just a dud, right? And it just wasn't meant to be. That happens. That's the cost of doing business, right? I'm not going to flex. I don't want this to come across as flexing, okay? But I'm going to tell you a little bit about me. I started in a 1-bedroom apartment when I moved out of my parents' house. And then I moved to a 2-bedroom apartment, and then a 3-bedroom apartment. And I rented a house, and I bought a house, right? And I bought another house, and bought another house. And now I live in a $3 million plus house. And I'm building a $5 million house right now, overlooking the city. And that's over 17 years of grinding. And you know how many crashes I've been through over that 17 years? Oh my gosh. If I had $1 for every stock that has crashed for me, I would have enough to build a $7 million house maybe, or a $10 million house. It'd be ridiculous. It happens all the time. Every year, I'm going to have some stocks in my portfolio that crash. It's the cost of doing business. Sometimes I'm going to have stocks that don't work out. And I'm going to sell for a huge loss. Cost of doing business. Do I sweat it? Nope. Because it's the cost of doing business. You can't have, I just showed you guys, Revolve is a 7th active position. Not even all the ones I sold off over the years like Tesla and all the others, right? 7th active position in the public account that has a triple-digit gain. How do you think I get the triple-digit gains? I got to go through the pain too. You don't get those insane gain stocks without going through pain in other stocks. If I'm going to buy a stock that's going to go up 2,000%, I might end up screwing up another stock that goes down 50%. So I put $100,000 in one stock, goes up 2,000%. My $100,000 becomes $2 million. Put $100,000 in another stock. I screwed up, got it wrong. It goes down 50%, right? Completely crashed. And that 100,000 went down to 50,000. That's fine. That's fine. It's the cost of doing business. And so you got to understand, as long as you're doing the right things when it comes to judging these companies' fundamentals, income statements, balance sheets, cash flows, PE ratios, running your projections on 1000xstocks.com, all that good stuff, right? Making sure you're paying a fair PE, making sure you're running your compounded annual growth rates, right? And trying to figure out, okay, is this stock actually a buy? How high a risk is it, right? And keep in mind, if your bear case for a stock looks pretty ugly, then that bull case better be really, really dang exciting. Like I showed you with AMD, right? I think AMD comes with certainly plenty of risk over the next 4 years. But guess what? AMD also could be one of the biggest gainers of big tech over the next 4 years. Would I be shocked if over the next 3 or 4 years, AMD was the best gainer of big tech? I wouldn't be surprised at all. I'd be like, oh yeah, I could have saw that, right? At the same time, if AMD was like a flat stock for the next 3 or 4 years, would I be shocked about that? And I'd be like, no, it was a possibility. It was a 10% probability. That could have happened as well, right? So that's the name of the game. And you just grow and grow and grow over time. But there's no way you can play this game without pain. You can't have the success without the pain. Ask any athlete that's, been successful at their sport. Guess what? There's a lot of pain that comes along with that. You know how many losses they have to take to get that championship? You know how many hard training sessions they have to go through to get that championship? There's plenty of pain. But if you aren't willing to deal with the pain, you'll never get the gain. And you'll never live the life that you want to live, your dream life. Whether that be to live in a certain type of house, whether that to be drive a certain type of car, whether that be to retire early, or, retire family members, or give lots of money to charity, right? I can't wait I'm looking so forward to December, because every December I give to charity, right? And then, far majority of my money, 90% plus, if not 99% of my money will be donated to charity when I die. So, what are your goals? You're not going to be able to achieve your goals if you're not willing to go through the pain. There's no doubt about that, man. You'll never live that sort of life. You want to eat at certain types of restaurants. You want to go on certain type of vacations that you always dreamt of. Man, I wish I could go here, but I can't go there because, I don't have the funds for it, right? Man, I would love to retire my parents, but I just can't do it because I don't have the money for it, right? I want to do this. I want to do that. I want to pay for my kids' college, but I just can't do it because I don't have the money for it. And I want to set up my kids up for life. I just can't do it for it. All these things that people want to do, they can't do because they're not willing to go through the pain. You got to be willing to go through the pain. And the pain is also doing all the research work on these companies. You know how many late nights I've spent to 1 a.m., 2 a.m., 3 a.m., listen to conference calls, running projections, trying to figure out, thinking about these companies inside and out. Okay, am I missing something here? Well, what if this happens? How am I going to play this? Okay, if this happens, am I going to buy more of the stock? Am I going to sell it? Am I going to hold? What am I going to do? Gosh, it's a lot of work, a lot of pain, but you can't deny the fact that, the dollar amount's there, right? And your dreams are there, your financial dreams, right? There's a lot of people that want to have more kids and literally refuse to have kids because they can't afford it. That's sad. So it's either you go through the pain, the work, to get to where you want to be long term, right? Or you don't, and you never live your dreams. Let that sink in for a moment. What do you choose? Some people say, you know what? I'm not willing to go through the pain. I'm not willing to go through the work. Yeah, I'll never live my dreams, but at least I won't have gone through that pain. That's just a life I can't live. There's never been a life I could live. I made a decision 17 years ago that I said, the life I want to live is the one where I do the things that you only get, from my understanding, correct me if I'm wrong, you get one chance at this thing. You get one chance at life. Right? So in that one chance, you better take advantage. Because last time I checked, we ain't coming back. So if you have things you want to do in this world, you got dreams, you want things you want to experiences, be in that moment and be like, dang, man, I really did this. I can't believe I'm here right now, doing this thing, right? You better put in the work. You better go through the pain. Or you're not going to be able to get that experience you want in life, right? And as humans, the biggest thing that I think always keeps us going is one day achieving our dreams. And everybody's got dreams. And if you don't, that's kind of a sad life, right? Everybody's got dreams. Everybody's deep down. Some people know what it is. I want to do this thing, right? Some people, you got to dig deeper. It's in there. You just got to dig deeper a little bit. And then you realize, they got all these things they really want to do in this life, right? All these things they want to achieve. And so anyways, just some thoughts on that, okay? Pinned comment down there will be to apply to join private stock group, private wealth group, take your knowledge up to a much higher level than where you're at right now. Join 6 and 7, 8-figure investors and all that good stuff. Get your Steel membership card sent to your house and take this stuff serious, okay? AMD. You are looking at a company in AMD that is transforming its entire business model right now. I have some things to show you today that are monumental in regards to where AMD is moving, what's going to happen with the stock price from here, what's happening with the business fundamentals. We're going to talk about AMD all in depth at the beginning of this business. I have some things to show you in this one, okay? Then I want to spend a moment talking about Fubo. Fubo reported earnings yesterday. I know a lot of people wanted my 2 cents on what's going on with Fubo, so I thought I would throw that into this video here today. So we'll focus on AMD and then throw in a little Fubo here. And then there's 2 clips I got to react to here on the reaction channel here today. Alex Karp, I only have seen a little small clip from this clip. Essentially, I saw it on X. I can't wait to react to this whole interview. And I was looking at the comments and that made me even more excited to read this. Somebody said the interview is a clear sell signal. Bro had a meeting with some white powder before this interview. Oh gosh, some of these are pretty pretty darn funny, right? This guy really knows how to get off topic fast. An anti-woke pro-Coke company. Oh, this is going to be an interesting one to react to here today. And then Tom Lee went on CNBC yesterday talking about the S&P 500 going to 7,500, right? All of a sudden, people are getting shaken up in this market. They're seeing Bitcoin. They're seeing the risk on stocks. All of a sudden, selling off. They're like, whoa, what's going on here? Tom Lee says it's all going to be okay. Okay, so yeah, I got a lot to get into in this one here today. I hope you guys enjoy this one. I appreciate you joining me. This is busy season for me. Earnings season is like nonstop. I need some of whatever they give Carp. I appreciate you guys for joining me. One thing only I need from you, not the white stuff. I just need a thumbs up, okay? If you just give me a thumbs up, man, that's all the white powder I could ever use right there, okay? Just little thumbs up action. That's all I need, okay? And additionally, if you want to be subscribed to the channel, you can certainly subscribe. We are now at how many? Oh gosh, I think 117,000 subscribers here in the reaction channel. So appreciate each and every one of you for being here. My private group, that will be the pinned comment down there. If you're looking to apply to join us in there, we are now up to a shocking 2,826 members in there. I'm considering shutting it down at 3,000 members this year. So I haven't made a final decision on that, but I'm considering shutting it down at 3,000 members for this year and then opening it back up at some point in 2026. So if you want to join us in there before I shut that down, that will be the pinned comment down there. It's access to all my course curriculums, private Discord chat, AMD chat's been popping, obviously, and all that good stuff, okay? Plus exclusive videos from me, see the stocks I'm buying, selling each week, all that good stuff, okay? That'll be pinned comment down there to apply to join us. AMD. So what are my thoughts about the stock? Before we get into the business fundamentals, the monumental things that's changing for where AMD stock price is going over the next 2, 3, 4 years, let's just talk about the short term of the stock price. What do I think about the stock going down after hours? Here's the deal. If you look at all of risk assets right now, they're all trending lower. It doesn't matter what it is. And when I say recently, I'm really just talking about like the past week. The Nasdaq's down about 3% in the past week from its all-time highs. It hit about a week ago, right? If you look at NVIDIA stock, that's down quite a bit. AMD's off a bit from where it was at. Bitcoin, I mean, it seems like Bitcoin not that long ago was 120,000 plus, right? Bitcoin, last time I looked, was 99,000. So that's selling off. Bitcoin's always a phenomenal thing to look at in terms of, is the market wanting to go risk on or risk off? Usually if Bitcoin's moving up and up and up, then that's just usually a sign that people want to take more risk out there. Bitcoin continues to sell off. It's clearly a signal that people are like, you know what? I'm not quite as enthusiastic about buying right now, right? So they're kind of laying off a bit. And so my thoughts in regards to stock is, based on these results and what I'm about to get into here, the stock should be up after hours. But it's hard to go up if you're in a risk off market, right? And look at 2022. That's a perfect example of that. That market, we watched the Nasdaq go down about 37% peak to trough, right? From that peak in 2021, Q4 2021, to the trough in Q4 2022. 37% down move for the Nasdaq. It didn't matter what you were doing in your business model. Everybody was going down. It didn't matter what stock it was. It could have been Coinbase. It could have been Robinhood. It could have been Meta, Google, Apple, Microsoft, NVIDIA, AMD. Everything went lower, right? Palantir went to $6. I think it was like $5.98 at the lows or whatever, right? Like people don't want to take risk. They just put on that selling pressure, right? And selling pressure can add to more selling pressure. That's just something to keep in mind there. And, you know, this is a message I gave to the private, or not the private group, I gave to the main channel today, I think on Eclipse channel, because I released that video, 4 stocks I'm buying, November 2025 edition. And then I did a little short, I guess it's called, for the main channel. And I was telling them, I see some people out there worried, scared about a 3% down move in the Nasdaq. And I said, man, if this is scaring you, if this is shaking you up, you better get ready, because this is nothing. 3% down in the Nasdaq put me to sleep. Like, get ready for 10% down the Nasdaq. Get ready for 20% down the Nasdaq. Get ready for 30 and 40 and 50% down for the Nasdaq. That will come down the road. Promise you. It always does, right? You think it's never going to happen? No, it always happens. I mean, just this year, look at just earlier this year, it happened, right? Like we had NASDAQ move down about 20%. Quick. That's how it happens. And so just understand what you're seeing in front of you right now is nothing. This is easy peasy lemon squeezy. This is like you try out for football and it's the first day of practice and you do some conditioning and you're like, oh, this is too much, right? And some people tap out that first day and then they never come back, right? Oh, I thought football was going to be fun. This is brutal. I got to do conditioning, right? They don't even make it to the hitting drills. Then you start the hitting drills, and you get a whole bunch more people to drop out. That's what happens in the stock market, right? It's all fun when you're signing up and you're getting your pads. Then you got to actually go to practice, put in the work, And in the stock market, the equivalent of that is when you start going through a downtrending market, whether it be for a few weeks, a few months, or a year, right? 2022 was a great one to go through in terms of, are you battle tested? You send the NASDAQ down 37%. You send many of the most popular stocks in the market down 50 to 80%. Now we're talking. And that was about a year downtrend there. Now that's big dog stuff, right? You can survive a year-long downtrend. Whew, 35% plus down in the NASDAQ, you can survive anything in the market, okay? Alrighty, that means you're built. So that's my opinion in regards to stock. Now, in regards to what's going on with the business model, there's some very fundamental things that are huge happening here with AMD, okay? First off, their guidance. So before we get into this last quarter, the guidance was very important. Here's why. We know Lisa Su likes to usually sandbag and put out numbers that she's confident the company's going to beat, right? She's got a lot of respect on Wall Street and from investors because they know if she puts a number out there, her and the team put a number out there, they're going to come in and beat that number, right? And like AMD's not going to come in and disappoint you and do a number way worse than they anticipated, right? Now, I said based on the guide, it looks like, in my opinion, they're going to do $10 to $11 billion next quarter because they're basically guiding for a midpoint of $9.6 billion. The top end of the range is 9.9. I think Lisa Su and the team is not going to put out a number on the highest number that basically they're going to be confident they're going to beat that number, in my opinion. So I think what they're actually going to come in with next quarter is somewhere between 10 and $11 billion. That's my personal opinion, okay? And so I think they're going to come in and beat that highest end of the range, right? Somebody asked if one of the members of Private Stock Group, they said, they asked if I was going to record an AMD video. I said, it's about 96% probability. I said, the 4% is YouTube goes down, Loom goes down, or I slip on my dang kids' toys and hit my head, right? Oh, gosh. No, another thing I was actually talking about in all seriousness here, I was talking about gross margins. And those continue to accelerate. I said those gross margins are up to 52% now, was 40% last quarter. My guess is those continue to roll up over the next 1 to 2 years as they launch higher end products out there, right? Now, in regards to the income statement of the company, guess what? A plus. Banger, an absolute banger of a quarter for AMD here. Revenue, $9.2 billion from $6.8 billion. Unbelievable growth for the company. Cost of sales went to $4.2 billion from $3.1, but when your revenue's up that much, like the company's revenue is up like $2.5 billion year over year. So if your cost of sales on $2.5 billion of revenue up and your cost of sales is only up, let's call it just over $1 billion. Yeah. You're looking pretty good there, right? Your gross margin is going to likely explode. So gross profit went to almost $4.8 billion from $3.4 billion. Gross margin went to 52% from the same quarter last year, 50%. And in the latest quarter was actually at 40%. So a massive acceleration in gross margin, literally just quarter over quarter. Like, listen, ladies and gentlemen, 12 percentage points of gross margin lift in just a sequential basis is unbelievable. Like that almost never happens with the company. You could do maybe like 12% on a year over year basis would be insane. But when we're talking about 12 full percentage points, 1,200 basis points of increase of gross margin on a sequential basis, flip my flapjacks. Oh my gosh, flip them right in the air, right? Research and development went up a bit for the company, but I actually kept that pretty in check, I thought. Marketing, G&A was up a bit for the company, but I thought they kept that pretty in check considering how much revenue was up for the company, right? So total operating expenses was up for the company, but for the numbers they're doing for this company, that's no problem at all, right? Now, net income went to $1.2 billion for the company versus $771 million in the same quarter last year. So I love it. Love it. If a company can have strong double-digit revenue growth, which obviously AMD is very, very strong double-digit revenue growth, right? And I love it if their margins are also increasing and their net income's increasing at even a faster clip than revenues. That's like the trifecta for me. That's a trifecta of beauty. Now, diluted EPS went to 75 cents from 47 cents. Unbelievable, man. Just a banger for a quarter. Just a banger for the quarter. Obviously, everybody's very, very happy about AMD in my private stock group, right? The thing is, with my private stock group, like, everybody in there has the same mentality as me, right? Otherwise, you wouldn't join. Like, everybody has the same mentality as me. We're all focused on the long term. We're focused on the fundamentals of the companies. If AMD stock was up or down 3% after hours, it's irrelevant. It all matters where AMD stock is going over the next 2, 3, 4, 5, 6, 7 years, right? Now, this is very important what I'm about to show you, everybody right here, okay? You want to always look at how is a company's business segments doing on basically a quarter over quarter basis. Are they accelerating growth? Are they decelerating growth? Okay. Here's what we find with AMD. This matters so much if you want to know about AMD stock and what's actually going on underneath the hood. Okay. Look at this. The data center business grew revenue 22% year over year to $4.3 billion. That's the raw number. Okay. If you look at last quarter, the data center segment did $3.2 billion. So they just grew that business $1.1 billion on a quarter over quarter basis, not a year over year, a quarter over quarter, which shows how heavy the 350 series is starting to matter, right? Additionally, revenue growth was up 14% on a year over year basis. They just accelerated that to 22%. That is unbelievable, okay? Operating income for the segment, $1.1 billion versus actually an operating loss in this same quarter last year. If you look at the client and gaming segment, they did $4 billion of revenue in this quarter. They just reported, okay? What did they do in this same quarter? The previous quarter, they did $3.2 billion. So that went to $4 billion from $3.2 billion. Growth rate was 14% here. I'm looking at that. I didn't update this one to the client segment. Client segment, $3.6 billion last quarter. This quarter, they just posted $4 billion. So that's another acceleration of $400 million of extra growth on the business on just a quarter over quarter basis. 73% revenue growth for client and gaming segment here versus 69% in the last quarter, essentially, right? That's phenomenal. And then if we look at embedded segment versus embedded segment, okay? So if we look at embedded segment for what they just reported, that business was down 8%. Now you look at the quarter the previous quarter, they were at down 4%. So you may say, oh boy, they were at 4% down. Now they went to 8% down. Look at the raw number though, because that matters even more so. $857 million they just did in embedded segment revenue versus $824 million to be exact in the previous quarter. So the fact is the raw number is actually increasing. I know the percentage looks worse, but actually that business has bottomed and it's actually picking up in regards to revenue. That matters so much. And that's where you got to really look under the hood deep into these numbers. And all of a sudden you realize, okay, so what do we have? What's the moral of the story here in regards to AMD and the numbers? Every business is strengthening. Every business line was up considerably, with obviously data center being the winner, chicken dinner. But the fact is, data center grew quarter over quarter. Client and gaming segment grew quarter over quarter, and embedded segment grew quarter over quarter. So that matters significantly to this company, right? And so, I couldn't be more happy. The balance sheet's a banger. I mean, look at the balance sheet. Now, in this latest quarter they just reported, they are now up to $7.2 billion in cash equivalents, and short-term investments. Look at the accounts receivable. Accounts receivable now up to $6.2 billion from $5.1 billion. So cash and cash equivalents and short-term investments, just on a quarter-over-quarter basis, we're not talking year-over-year, just quarter-over-quarter, up 23%. Accounts receivable just on a quarter-over-quarter basis, up 21%. Right? And then look at total debt, flat. Beautiful. Is a beautiful, okay? So AMD's a banger here before we get into Fubo, Alex Karp, and Tom Lee. Just to leave it on AMD before we move on here, everything's going exactly the way I expected it to. And that's all I can ask for. What happens with the stock in the short term? I mean, if you tell me the S&P 500 goes down 10, 15% over the next 30 days, well, AMD's going down too. You're not going to fight that, right? The question is maybe AMD only goes down as much as the market. And when the market starts bouncing back, it comes back way stronger. That's something to keep in mind there. But that's going to be what that's going to be. The moral of the story is AMD is going to 300. And then you know where AMD is going? 400. And then when you know where AMD is going? 500 plus. Based upon everything I see in the numbers, remember, right now is the appetizer. We're at the appetizer stage for AMD. We haven't even gotten to the entree. The main course is coming. That starts in the second half of next year. And then 2027 is a blow-off top year for the company's revenues. So we're just at the appetizer stage, ladies and gentlemen, okay? So if you think this is good, you ain't seen nothing yet, okay? You ain't seen nothing yet, ladies and gentlemen, okay? Fubo. So in regards to Fubo here, a D income statement, which actually is an improvement for them because they've had a lot of F grades over time, right? Overall, they cut down their losses in a substantial way, right? They haven't been spending that aggressively on marketing for this company. Look at sales and marketing. They actually brought that down considerably year over year from 55 million to 42 million. And you might say, why? Well, the main reason I think they brought marketing sales down is they really were trying to focus the business on profitability short term, because they just finally cleared that deal for Hulu Plus Live TV. So they're going to get millions and millions of new subscribers coming onto the whole company, which is like a massive quantity of growth there, right? So in the very, very short term, they don't really need to focus on attracting more members. 2026, especially the back half of 2026, they can start trying to figure out, okay, let's start attracting massive amounts of new members again and things like that, right? But in the short term, like you just did this deal, you're now becoming a giant in the space. You don't really need to just focus on profitability in the short term, then focus your attention back on marketing and spend as far as that goes. And now that Disney's going to be very involved, their marketing and their ads and all that stuff is going to end up being a lot better, and they'll get likely way better conversions that when they're by themselves. Okay. So if you look at net loss from continuing operations, that went to $18 million. That was $54 million in the same quarter last year. This was always like a big money losing quarter for the company, because they usually spend a lot on marketing because getting ready for football season, right? And so Fubo is honestly looking like they could build into a profitable giant. Obviously, they'll have a bunch of one-time weird expenses over the next probably 6 to 12 months because of the deal going through, and there's a bunch of one-offs you have to have, and certain groups might have to be let go because you got duplicated roles and all that stuff, right? But the moral of the story is like Fubo's looking like they're about to build into a profitable beast. And then the question is going to be, how profitable is this company going to get? Okay. So, everybody got used to thinking like Fubo is just going to lose money forever and ever. And like, no, they've been clearly showing a trend of getting things better. And the other big thing I thought with Fubo that I don't think a lot of people understand how impactful this is the advertising business has always been a huge underperformer in my personal opinion. I don't know why that is. Maybe Fubo had a bad team running the advertising, right? Maybe advertisers didn't respect Fubo because they were too small, right? I don't know what it was, but advertising always underperformed for Fubo. Listen, something big just happened. Now they're going to start using Disney for the advertising side. So they're going to be able to leverage the Disney assets for their ads, right? Which means they're going to have a lot more power, a lot more say with advertisers, and they're going to likely be able to generate a lot more money because now they're going to be going through a big dog. So that matters significantly, So that ads business should pick up by miles over this next, year or two. And remember, the ads business, that's where the real money's at. There's the subscription part of the business, which, I pay, I think Fubo, I get the highest end plan for Fubo. So I think I pay like $100 or $120 or something a month for Fubo, right? That's cool. And Fubo can make money there, but that's not where the big money's at. The big money's actually with the ads. That's where you can actually make big money because you get a certain amount of ad placements on programming. So I love it, man. I love it. And then obviously there's a YouTube fight with Disney going on right now, which could drive a lot more customers over to Hulu Plus Live TV. It could drive a lot more customers to Fubo. So that is what it is. And so Fubo, love it. I'm excited about that company. I think the stock's going to 5. Then I think it's going to 10. Then I think it's going to 20. And, it's a speculative hold I have, but it's getting less and less speculative as time ticks on, right? And they're still in the gulag right now. I mean, the stock, I'll be honest with you guys, that stock should be out of the gulag right now. The fact that it's under $5 right now is a crime. That's the best way. It's a crime that stock's under 5. There's no reason, given how strong Fubo's balance sheet is, given now that they're tied in with Disney, and they got the Hulu Plus Live TV, and now they're going to be like a real player to now actually fight against YouTube TV and other competition. That company should not be under $5 right now. That's a crime. So take that for what it is. I bought some Fubo stock in the last 24 to 48 hours. Let's just put it that way. Okay. Alex Karp next up here, and then we'll get into Tom Lee.
CEO Alex, it is so good to see you this morning.
Cheers, ladies and
we
gentlemen.
had your biographer on the broadcast before, and we're speaking about you now in third person, but now we're doing it in first person. The earnings were a blowout, I think, across the board. We can talk about maybe why the stock market reacting the way it is.
I had a very in-depth video on Palantir. I posted that on the reaction channel here. So if you want my very in-depth thoughts focused around Palantir, check out the video I released here on the reaction channel yesterday. Okay. That was a banger if you're really into Palantir stock.
But, I was listening to the call yesterday, and I wanted to, just for those who didn't get an opportunity to hear it, I think you made some fascinating points about why you think this company and maybe even yourself are so misunderstood.
Well, there are lots of easy ways to misunderstand me. I misunderstand myself. And, it's not like the super conventional playbook thing. Look, we're an anti-playbook company. If you want to do the personal version, I'm like this dyslexic, formerly, and I believe currently still left of center, who actually sticks up for progressive values, which triggers, TDS loving people, because I think the Democrats aren't no longer progressive. And then the company is built in a truly sui generis, unique way, which would only be possible in America, and actually explodes every assumption of how an expert would build a software business. The more you actually know about building software, the more odd, unique, and inexplicable our rise in success, and I would say domination on the enterprise software battlefield looks and is. And then I would say one of my main issues is Palantir, because we called a lot of things that are kind of establishment views that often are viewed as kind of being
this guy. He's like, that's Alex Karp. He's the only person that knows probably who Alex Karp is right there.
Super woke into question in every single assumption of Palantir. The people who piled in to Palantir were people investing their own money, often people who are not in the investor class, non-experts. And even till today, the experts sit on the sideline and say, hey, this can't be true, while the average American who invested in Palantir, and for the first time, maybe arguably since World War II, average Americans got venture returns investing in Palantir. So you have this massive divide between the average.
All right, Mr. Karp, got to push back against you there, okay? Listen, Alex Karp's kind of saying like, oh, we're the only ones people make. No. Tesla's made retail investors life-changing money. Palantir, sure. Yes, absolutely, right? Meta's done the same. Apple's done the same. Microsoft's done the same. Google's done the same, right? Like I could go down a long list of companies that have made investors life-changing money, right? You got even companies like Elf Cosmetics, obviously made me ridiculous sums of money, right? Celsius Beverage, Monster Beverage, one of the best returning stocks in the entire stock market. If you look at, basically 2000 returns to 2020 returns, like that 20-year span, one of the best returning stocks you could ever find. There's a long list of stocks that got retail investors rich, right? Palantir's one of those. Nvidia's another one, right? AMD's another one. Like there's people that were loading up on AMD at $1, $2, $3, $4 years ago, 10 years ago, 10 years ago, AMD was like a $2 chuck. It was a $2 stock, right? And obviously if you rode that wave to 200 plus now, like you've made life-changing money. So Palantir absolutely deserves its credit for making a lot of people a lot of money, but to push back against Alex Karp, let's not act like you're the only one. Like there's been plenty of stocks, and there'll be plenty of stocks over the next 5, 10, 15 years that will make people life-changing money that, they'll look back and be like, I cannot believe my portfolio says this amount of money.
Person who evaluated themselves and the expert class that still was working on assumptions that have historically not been true, that obviously, if you look at the earnings, if you actually look at, we grew the company, I'll go through if you want to go through the numbers, but extraordinary results. Yep. And then the expert class is weak-kneed and the retail people are all in. So, but in fairness...
But that's what I wanted to ask you about. Yeah. In terms of because there is a misunderstanding. Clearly, you look at the analysts, most analysts, think that this stock is overpriced. You have people like Michael Burry out there shorting it. Everybody who's shorted this stock thus far has been on the losing end of it. And I'm trying to understand if you look at sort of the growth trajectory, the sales, how much of the sales, frankly, I think actually even there was a huge part coming from even existing customers, and just what the scale of this thing ultimately looks like in your mind.
Okay, there are two parts. Of course, when I hear short sellers attacking what I believe is clearly the most important software company in America, and therefore in the world in terms of our impact, simply to make money, and trying to call the AI revolution into question, where we have this anomalous numbers, 114, rule of 40, et cetera. It just is super triggering because these people, they can pick on any company in the world. They have to pick on the one that actually helps people, that actually has made money for the average person, that is actually supporting our war fighters. Why do they have to go after us? And I'll tell you what, it's crazy motivating, because I'll tell you why the short sellers are constantly getting screwed by Palantir. Because every time they short us, We just are like tripling down on getting the better numbers, and part, honestly, to make them poorer. But okay, so the question of like the actual power of the business and what is it worth? I mean,
in all due respect, Alex Karp, okay, listen. I wish I could talk to Alex Karp because he actually stressing. He's stressing over this, like, you know, like, oh, short sellers betting against stock and these sorts of things. The man's stressed about this, right? It's like super trigger. Listen, success is going to bring a level of hatred. It's going to bring a level of envy and jealousy and those sorts of things. That's what happens, right? Even myself, like, I'm not some super famous person, but I have a lot of people that watch my channel. You think everybody that watches my channel likes me? No. If a video of mine gets, if 100,000 people watch this video, guarantee you at least 1,000 people don't like me. They actually hate me. They talk trash about me. That's just what it is. You think every musician, you think everybody likes Taylor Swift? No, okay? You think everybody likes Tom Brady? Like, no, okay? Like, anybody that's got a level of success, you're going to attract some negativity. You're going to attract haters. You're going to attract people that don't like you. And that's fine. Like, don't stress about it. Like, that's what you signed up for. You understand? You sign up to be super successful, to have a lot of money, to have a successful company, do anything big in this world. You're going to have a certain amount of people that don't like you and want to see your company fail or whatever, right? And short sellers, that's not like most short sellers they're not betting that Palantir is going to zero. The company goes bankrupt. They're betting that Palantir is going to go down 50% or something like that, right? Like, it's going to be a short term, big move down for the stock. They're not betting that Palantir is going bankrupt. Like, you know, so like, man is stressed about this, like stressed. And like, if I could just talk to him, I'd be like, dude, chill. Chill. They're not betting your company's going to zero. They're not betting that you're going to go bankrupt and you're going to be, you know, begging for change on the side of the road. Like, you know what I mean? And Palantir, to take it one step further, a lot of people don't like Palantir's products. They feel like Palantir's military related products are not good. Let's just put it that way. And when I say not good, I mean like they're too good for the battlefield, as in like they cause death. Like, I don't know what other way to put it. So they don't actually like Palantir, the company, because its products could be very, very deadly on the battlefield. And so that, like, you know, like, dude, like, chill. Like, you're going to have some haters. Like, there's no doubt about that. Like, that just is what it is. Your company's going to have some haters. Like, get used to it.
Today, one of the things that is actually in the book, the biography, and that I actually think you always have to ask is the person persuasive or are they right? And across all sorts of movements, political, I mean, you see this on the regressive part of the Democratic Party. We're about to probably have a complete disaster. I was born in New York. Like, but if you actually said...
Oh, yeah, and then the man, you know, crapping on the Democratic Party. Like, okay, you want more enemies? You know what I mean? Like, this is the second time he's brought up Democrats in a negative light. Second time. This has been a 4-minute clip. He's brought up Democrats in a negative light twice now. Twice. And you wonder why some people don't like, come on, dude. Like, whoa, what planet are you living on?
These things actually work. Everyone's like, of course I'm not going to vote for that. But instead they ask, does it work in theory? The theoreticians, you have to ask, how often have you been right? And Palantir is about pragmatic decisions that create unfair advantages for America and its allies. And on that, we've been right for almost 20 years on all major decisions. And I believe we'll be right going forward. Now, you could argue, I don't know, like they're constantly like, but they thought Palantir was overvalued at 10. They thought it was overvalued at 20.
That's fair.
I'm not even here saying what the valuation is. I'm just saying, find a company in the world that has a rule of 114, that has U.S. commercial growing at 121%, that aggregate growth in the U.S. is 77%, that has throwing off free cash flow in a way that's anomalous, and that is fully aligned with our customers. And you figured out the value, but they're in the business of being skeptical and being wrong, and we're in the business of giving an unfair advantage to American workers, American warfighters, and our investors.
Being short is a very difficult place to be because you can lose it.
And also, to be fair, you know, this I got to stick up for Alex Karp in this big respect. Okay, listen. A lot of times CEOs are asked about the valuations of their companies, right? Listen. Just because you're a CEO of a company, you started a company, does not mean you know how to properly value companies. That's not how this works. I would say 99% of CEOs and CFOs do not properly know how to value a company. Have no clue. Why do you think every company, when they actually go to acquire another company, they hire professionals to like assess the assets and if this business is worth this, right? If they knew how to do that themselves, they wouldn't go pay tens of millions of dollars of fees or hundreds of millions of dollars of fees to investment banks to then go assess like, is this company that we're going to buy, like this new software, blah, 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 is it worth it? And so Alex Karp doesn't spend his time running valuations. So he doesn't actually know if his company's overvalued or undervalued. Like he's a CEO and he's, founder. So he's going to always assume his company's undervalued, if anything, right? We're going to grow forever and all these sorts of things. And that's every like I said, like 99% of CEOs, they don't know how to value companies. That's a whole skill set you have to bring up, right? Like no different than if you plugged me into Palantir, I wouldn't know how to run that business today. Why? Because I haven't built up the skill set to go run Palantir. If they wanted to have Alex Karp and me switch roles right now, Alex Karp's going to have no clue to do what I'm doing. And I'm going to have no clue to do what Alex Karp's doing. Because you know why? He hasn't focused the last 17 years on running valuations on companies or trying to figure out if an asset's undervalued or overvalued. And I haven't spent the last 17 years trying to run his business. You know what I mean? Like we both fail. And so like it's just crazy. But they ask these CEOs like, oh, the valuation of your company, thinking they're going to know, like, they're just going to talk up their stock. Like, yeah, we're doing all this stuff. We're growing. Like, I don't know, valuations. Like, come on, man. Come on.
You can drive these people into the ground.
Thank God.
Like that. Michael Burry put a really big bet on it. It's almost $1 billion. It's $912 million. That's a big step for him to put into that. When you say you redouble your efforts, what do you do? What do you go back in?
Well, first of all, he's actually putting a short on AI. So the way I read it was us and NVIDIA, and it's like
he's the biggest position is you, though.
Yeah,
I'm just through all the shorts.
Great. Okay. So, and then, by the way, with the shorts, it's very complex. It's not even clear that, honestly, I think what is going on here is market manipulation. We delivered the best results anyone's ever seen.
Stop it, Alex Karp. Market manipulation. Stop it. You got almost a $500 billion market cap. Oh, gosh.
It's not even clear he's not doing this to get out of his position. I mean, these people, they claim to be ethical, but, they're actually shorting one of the great businesses of the world. And I'm not against shorting as a matter of theory, but I'm just saying pick something that is not doing a noble task. And, it's us against them. And that's a good position for us.
But to be fair, once again, like Alex Karp, you view your company as a noble company, but a lot of people do not. A lot of people do not. You have to acknowledge that.
When you're printing a rule of 114, again, people who aren't technical, I think roughly an incredible score, like an Olympic grade score on rule of 14 is like 50. I mean, that's roughly like if you're between 50 and 7, you're an Olympic athlete,
he's right.
A unique implement athlete. This is like Michael Phelps like score.
Yep.
Like Michael Jordan. Like there are no scores like this.
He's 100% on in regards to that. I mean, they're putting up numbers you just never seen before. Like, this is ridiculous. Like, yes, 100% he's right.
And 121 growth
Legendary.
Off of almost a 1.5 run rate in U.S. commercial and a 77% growth in the U.S. and an aggregate off of an aggregate base of $4.5 billion. By the way, I predicted we'd get here. So, it's like if you want to short that, be my guest. You go ahead. We're just going to go do our things. I mean, look, I'll tell you, there's a tale of two cities in our society. We need experts versus retail. And you see it like, I don't know why these newspapers are helping Mandani win. I don't know why we can't have honest discussions about our future. I don't know why we have to allow fentanyl attack. But it's almost always sympathy for the expert that doesn't need it. The short seller that has some ridiculous reason for doing something against. I mean, most of GDP growth in this country is because of AI. The real question is, how do we grow that and expose workers? What is the worker available GDP? That's the question for our society. Instead of aligning on that, we've got these completely. And again, if the numbers weren't there, great, be my guest. But then the numbers are there. So then you're not. It's not even clear he's actually shorting us. It's probably just how do I get my position out and not look like a fool? I don't know.
Okay, got to push back against Alex Karp here. He's just this ultra level of disgust and hatred of short sellers and whatnot, right? Listen, if Michael Burry is right and Palantir stock goes down a bunch, and Michael Burry makes $500 million in Palantir, how does it negatively affect Alex Karp and Palantir? Zero. Does nothing. Just because if if Michael Burry bets against Palantir stock, makes a bunch of money, it doesn't negatively affect anything. Like, okay, cool. No different than if Palantir stock goes to 400 and, Alex Karp gets a bunch richer, does that like massively negatively affect anybody else? No. That's just looking at the world from like a very false, like, and it's surprising Alex Karp will look at the world in a false tense, but he is. He absolutely is. He's looking at the world no different than somebody looks at a billionaire and says, how could they have all that money? They must be so greedy. Like, that's ridiculous. No one should have that much money, right? And this like false notion about like, oh, they won, so I lost, right? Because they're a billionaire, that means society lost. Like we lost that money today. Like, no, that's not how it works. No different than if Michael Burry makes a bunch of money on the stock going down and sells out in 3, 6, 9 months from now. It does nothing. It doesn't change anything with Palantir, their business model, Alex Karp. Like, it doesn't even affect you. But it affects Alex Karp. He's stressing about this. Like, crazy, man.
But I do think this behavior is egregious, and I'm going to be dancing around when it's proven wrong.
All right. Alex, we've heard a lot of talk from the likes of a Michael Burry, but more broadly about whether we're in an AI bubble, whether the economics make sense. Clearly, in the context of Palantir, they do make sense insofar as you're printing money over there. Not everybody in the AI space is printing money in the same way, and they're spending an enormous amount on chips, data centers, and the like. How do you see the broader space right now?
Alex Karp needs to chill, man. He's like going back and forth in his chair. Last time I saw somebody going back and forth, you guys ever seen the video of the guy with a last name that began with H back in the 1940s? You guys remember him? You ever seen him? I think there's a video of him at the Olympics, and he keeps like going back and forth, and they're like, said he was on some stuff. Let's just call it that. Alex Karp's freaking me out here, man, going up and back and forth, back and forth, back and forth. I'm like, oh my gosh, chill,
They
Karp.
do make sense insofar as you're printing money over there. Not everybody in the AI space is printing money in the same way, and they're spending an enormous amount on chips, data centers, and the like. How do you see the broader space right now in terms of just how things are developing?
There are two subtle issues in AI. What is the addressable market, and what is the addressable market for things that work? Meaning you make more money and the quality of the money is higher. So top line and bottom line grow. Palantir, we're in the business of a part of the addressable market where it works and it can be quantifiable, either commercially or on the battlefield. So clearly, and over time, you're going to have Pareto optimality, meaning that every part of the stack is going to have to create more value than they charge. That's just obvious. And if that doesn't happen, it will be a bubble. And, I'm sorry, short sellers can't tell the difference between products that work and products that don't, but these numbers should show you that there's a part of the market that, quote you, is printing cash, and it looks like that part of the market is the part we own. There's a separate question, by the way, which I think is equally relevant. What part of the GDP growth is available for workers? What we call worker available GDP. And that's like one of the unique things about Palantir is whether it's on the battlefield, like the people writing the scripts for these very complicated operations, or building batteries or doing things on the factory floor are being enhanced by our product. And those two questions are going to define arguably the future of what happens in this country. Does GDP grow because of AI, which only can happen if there's Pareto optimality, or in what the way we see it, the customer pays less than the value they create, which is abnormal, not exactly equal Pareto optimality. And that it's unknown, honestly. You have this massive growth, but currently, as far as I can tell, the two companies he's shorting are the ones making all the money, which is super weird. Like the idea that chips and ontology is what you want to short is batshit crazy.
Okay, so first off, let me expand on this point, and then I'll tell you Michael Burry's bet against Palantir and why it's a little different than how Alex Karp's talking about there, right? So Cheesecake Factory, obviously a stock I love. I think that might have been one of the 4 stocks I spoke about on 4 Stocks I'm Buying November 2025 edition that came out on the main channel this morning, right? So let's say I'm buying cake at 47 right now, okay? And somebody is shorting the stock and cake goes down to 40 and they make a bunch of money and cover. Okay. How's that negatively affect me? It doesn't. It doesn't mean a dang thing for me. Good for them. Maybe they could buy some cake shares at 40 now. Like, good for them. Like, it means nothing to me. absolutely nothing. And so, I wish Clark could understand this point about dude, if somebody shorts your stock and happens to make money, it doesn't negatively affect you. Michael Burry's bet, I believe, is on, he likely thinks Palantir is close to deceleration of growth, which obviously I've been talking about for some time now, right? And obviously it has a sky high valuation. So if you can start to get a deceleration of growth, let's say growth rates have peaked, that rule of 40, that's 114 right now for Palantir, is ridiculous. Maybe that's a peak. Maybe next quarter goes down to 110, 109, right? Still amazing, but you're starting to have a deceleration. And when you throw a sky high valuation that's at insane price to sales ratios of trailing 12-month Ps, forward Ps, 2-year forward Ps, whatever you want to look at for Palantir, it's all sky high. When you have decelerations of growth with sky high multiple, that's when you can get a nice move, pretty substantial move down on a stock for a 3 to 6 month span, right? Where Palantir could go from 200 something down to, 150, 125, which, could be a very, very profitable move in a 3, 6, or 9 month span. So now there's a risk of you not being right about that. And let's say rule of 40 goes to rule 120 next quarter or 125, you don't know, right? But if he can get his timing right, there could be a lot of money to be made in that move, and it doesn't negatively affect Palantir or Alex Karp in any way. So he needs to chill. Tom Lee.
The last couple of appearances, whenever actually it's been a while now, when you're on, I kind of hold my breath after some of your forecasts, because a lot of times I think no way, and then it's always seemed you have not been really wrong yet in any significant way. Do you ever have any trepidation, second?
Hold your horses for just a moment. Listen, as somebody that's been watching Tom Lee clips for a long time, and as somebody that's had the reaction channel since 2022, plenty of times Tom Lee's been wrong. Let's not act like Tom Lee's never been wrong. Same thing, I've been wrong. Everybody's been wrong in this game, right? Now you want to be right a lot more than you're wrong. But the moral of the story is everybody's wrong, and Tom Lee has been wrong. I remember it was a year or two ago, he was talking about small cap, 50% rise. That ain't never happened, okay? I remember in 2022, man was still really bullish, and obviously the market got slaughtered, right? And there's other examples as well, as far as some Bitcoin calls he made about it's going to this price and that price, and it didn't actually happen. So Tom Lee's been right, but remember, this man's directionally a bull, right? When you're in a 3-year bull market like we've been in, he's going to be right a lot more than he's wrong. So just something to kind of keep in mind there, right? No different than a bear looks right a lot more than they're wrong when you're in a bear market. But don't act like they're right 100% of the time.
So do you ever get nervous about any of your calls?
Yeah, all the time, filled with doubts because, the future.
No one can be right off your 51%. You're the best ever in this business. You're still bullish, even though you talk about last week, a little wobble in some stocks. Sell on the news because of China. It looks like a little bit of hawkishness out of Jay Powell. I don't know if that lasts.
Yeah, that's right. I think the market has a lot of walls of worry because we've got the shutdown, we've got China, we got the Fed speak, but the market's been up 6 months in a row now. Only 6 times since 1928 that's happened. So if you look at November, we're up 5 or 6 times. And in 1942, it was flat. So basically, November should be really strong. I think at least 200 points on the S&P. So maybe...
For November.
Yeah, maybe even 250. So maybe we get to 71.
See, that's a call that I just wish you wouldn't make a call like that, right?
You could
250
to 3% if that makes you feel better.
It does make me feel a little bit better because 250 points to say in November, 250 points. You're giving a time and a size.
But maybe we wobble the first couple weeks just to digest all the games.
Yeah, that's what I saw in your notes. So initially there could be some choppy trading at this point. What's driving everything? There's still, I guess, sentiment is not positive, is it? You mentioned the wall of worry.
Yeah, I mean, if you look at it like AAII, the average sentiment this year is still minus 11.5, net solidly bearish. That's only happened 3 other times in 35 years, all in the middle of bear markets. So investors feel like it's a bear market, but we're up 17%, which kind of tells me I think there's a big performance chase into year end. Over 80% of fund managers are missing their benchmark this year.
Wow. And you don't care about not having government data because does the market ever really wait for government data? Or it sort of sniffs it out, doesn't it?
Yeah.
The all-knowing market.
That's right. Because, we have a good Fed futures to look at what's implied for inflation. The Fed looks at the bond market. The bond market figures things out before the data comes out. I do think the inflation is probably falling a lot faster than everyone expects. I mean, you can look at trueflation and we're down to sub 2% inflation, excluding housing.
Shelter. Yeah.
Yeah, and shelter is finally cracked.
Yeah. Because that CPI number was, it was just barely cooler than expected, wasn't it?
Yes, but...
Okay, so before we go further here, and it gets on to other subjects, you're talking about 7,100. S&P 500, 7,100 end of November. What are my thoughts about that? I think it's a pie in the sky. Pie in the sky. Ridiculously bullish statement. Unless we can get the government shutdown to end very short term here. If the government shutdown keeps rolling all the way to Thanksgiving, I don't think there's any chance we reach 7,100 on the S&P 500 by the end of November. I don't think it's even remotely close to happening. If you get the government shutdown to come to a close in the next few days, there's an argument to be made. Maybe that could happen because that could add like a new bullish catalyst. People start feeling bulled up again. Okay, the government shuts down, it's over. You take that out. But the longer this government shutdown goes, I think it's starting to actually get people really scared. At first, they weren't scared. Wall Street was not concerned about this. Wall Street thought there was going to be no shutdown. And then they said, well, if there's a shutdown, it's going to be really quick. Now we're on the longest government shutdown in history. So now people are like, oh crap, we were wrong about it being a shutdown. And who's the guy that called this whole thing? I called this whole thing. I'm like, how do these Wall Streeters not see this? This is going to be the longest government shutdown by ever. I'm like, neither side's going to be incentivized. And I said, the side that'll end up giving in the end, it's going to end up being Trump. And I said, the only way Trump's going to give in is once the stock market starts getting hit hard. Once the market starts getting hit hard, they'll put the pressure on Trump to then fold back and be like, okay, let's give them their way here. The market still hasn't been hit hard enough. The market has to get hit a lot harder. Once the market gets hit a lot harder, that's when Trump's going to go ahead and capitulate on this whole situation and flip to the other side, right? And say, okay, let's get a deal done. But until that happens, he's going to stand strong. He cares a lot about the stock market. Did you see the 60 Minutes interview? He brought the stock market up and we're at all-time highs. We're doing amazing. He brought that up several times in that 60 Minutes interview. He's watching the market on like a day-by-day basis right now. So you start to really get this market hit, Trump will start paying attention. He'll capitulate. Until that, the Dems aren't going to move. Like, why would they move right now? They wouldn't. It doesn't make sense for them to move right now. And for T-Man, market's only down 3%, 2%, whatever. Nothing. Send it down all of a sudden 10%. That's the moment, right? Remember, as far as the whole Liberation Day and all that stuff, we didn't see the backtracking really until the market got hit hard. And then once the market got hit hard, then all of a sudden it was, this and that and this and that, right? So that's a whole game to play out here. And so the moral of the story is 7,100 is a complete drain unless the government shutdown comes to a close really rapidly here. But if that one rolls on all the way to Thanksgiving, nope.
The shelter piece is now at 0.16 month over month. That's at 2% year over year. That level would bring core inflation down sharply. And over 54% of the CPI components are now deflating. It's the highest percentage since COVID started.
It seems, Tom, that the markets have, largely because of what you're describing, moved on from the inflation watch.
Yeah.
They've kind of put that aside as maybe the forefront risk. And much like the Fed has been dragged to doing, wondering about downside risk to growth. I mean, if you just look at things like the reaction of home builder stocks, consumer cyclicals, regional banks, just to that hawkish cut by Powell last week, it seems like it's not hard to get the market a little bit uneasy about, just exactly what kind of a soft patch this is, even if we have confidence that maybe it firms up into next year. So how does that play into the overall action in the index and what you expect from the market?
Yeah, I think there is something the market's trying to figure out, which is AI is consuming jobs, but that's turning it into profits for corporates. So like profits are expanding. And then we have profit margins have actually been going up in the middle of tariffs. So how are companies able to take 70% of the tariff hit, but margins are going up? So there must be a productivity boom somewhere. And then we have, like you said, $7 trillion of cash on the sidelines, but we have high rates. And so the Fed, I kind of think, is trying to not overheat the economy, but we know.
There's another card at play. Okay, listen. You want to get a deal done? You want to see the government do a deal like snap of fingers? You want to see capitulation? Have the TSA workers start to go on strike and just not show up to work. And so all of a sudden air travel shut down. If that was to happen, boom. Oh, suddenly government is back open. Okay, if it gets to that point and TSA workers all just go on a strike and say, we're not showing up, you want to see capitulation? Imagine how embarrassing it was. You're the president of the United States and you don't even have air travel going on in your country. It's completely shut down. At that point, you have no choice. You have to capitulate, right? Like, it's just ridiculous. So that's the other card at play. One's the stock market, the other shut down air travel around the country. Oh man. And that's devastating effects to the economy, obviously.
Just point out, like, housing's in big trouble. So I would say it makes sense if inflation's in a good place and jobs aren't really strengthening for cuts to happen. And that would be really dovish. So I think that sort of comes together before the end of the year.
Andrew.
Hey, Tom, have you been reading all these stories that just been out, recently here about how the Fed is doing all of this sort of repo activity, like a lot of repo activity. And I just wonder what that really means for both the markets and maybe even for crypto. This is a ton of money. I mean, it looks like something like $30 billion just to ease liquidity concerns. This is, past couple of days kind of thing.
It is pretty typical into month end, right? That's what we are seeing. And I think that some of these numbers are also being distorted because of the government shutdown. So we know that the Treasury reserves are building because there aren't any payments being made. So it is something we're watching. But if I was to say that there's signs of bank stress, I'd also be looking for high yield spreads to be widening. And those are actually staying pretty calm.
So you figure no problem with 7,000 by the end of the year, more likely something even above that in your view? Like what? Like 7,300?
Yeah, I mean, maybe 7,300, 7,500.
7,500.
Yeah, so we still, in December, we would build on those November gains.
See, Santoli's like, no way.
No, I don't say no way. I'm open-minded to how far bull markets can go, right? Strong years end strong. We all know about that. The one piece of it I think it's worth kind of struggling with a little bit, though, Tom, is you can look at the AAI surveys, kind of what people are saying, and then you see, equity exposures in, Bank of America private client accounts are basically at their highs, right? So people have kind of, in aggregate, been riding this to some degree. And then you see a lot of what we've talked about in the last several months of, this kind of upwelling of speculative action in non-profitable tech stocks, low quality equities leading. That's not the Mag 7. That's like a lot of other marginal stuff. So how do you jibe that with that sense that people are still skeptical?
Yeah, I mean, one, we know there must be skepticism because if people were bullish, the institutional fund managers should have better performance. But as you know, this is one of the worst years for fund managers in almost 30 years. I think that there is also kind of problems in private markets. So I think private credit is doing terribly. And I think a lot of LPs in alternative funds, whether it's venture or private equity, are pretty disappointed by the returns, like the 5 years into now. But the stock market's done well. So I think that there is bearishness because like private equity hasn't come through and fund managers are doing badly. But you're right. The ones who stuck with public stocks are doing well.
I want you to quit while you're ahead, but I have to ask you about Bitcoin. I mean, you want to go out on a limb there too? Because it looks weak again today, 107. Go below 100 or no?
Well, Bitcoin, I mean, if I look at everything since October 10th, because that was the biggest liquidation in the history of crypto, like bigger than FTX.
Like a margin call almost.
Yeah, it was like almost a miniature rupture, like a tsunami. We're only a couple weeks from that, so I think the market is consolidating. But if I look at fundamentals, like Ethereum, stablecoin volumes have been exploding, application revenues at all-time highs. So right now, fundamentals are leading price in crypto. So I think eventually we consolidate and then we rally into year end.
150?
Yeah, I think we can still get to 150, 200 for Bitcoin. And then something like 7,000 for Ethereum.
Join us now.
150 to 200,000 Bitcoin by year end. What a call, right? What do we got BTC at right now? 101. Yeah. That's a big call. Big call, Tom Lee. So we'll see what happens with that, okay? Hidden comment down there if you're looking to apply, join private stock group, private wealth group, get access to all my course curriculums, private Discord chat, all that good stuff. That will be linked down there. So, oh boy, it's going crazy in there. Major upside stocks to share with you here today and why these stocks have so much upside ahead. We're going to get into all that in this video here today. 3 of these 4 stocks I'm about to share with you are hated stocks over the past year or two. I mean, absolutely hated stocks. Now you might say, why would you want to be buying some hated stocks? Doesn't that mean they're bad? Doesn't that mean they're not going to do well over the coming years? Well, here's what you got to understand, okay? Many of my best performing stocks I've ever owned in my life, we can call it the game changers, the portfolio changers, the life-changing stocks, right? Many of those stocks were absolutely hated stocks. A la Palantir. Palantir was a $6 stock in 2022. The stock had fallen 70, 80%. People hated this stock. They thought it had no future. Today, people are willing to pay $200+ for Palantir stock. SoFi stock was a hated stock just last year in 2024, right? This was a $6 stock last year. People thought it had no future. Now people are willing to pay $30+ a share. Meta stock in 2022, somebody sold me shares at $88.94 for the stock in 2022. The same stock that a year before they were willing to pay $300 and now they're willing to pay $650 for, right? Tesla stock, one of my best stocks ever back in the day, right? When I started buying in that stock like 2018, 2019, that stock had been dead money for like 5 years. People thought like the stock was never going to move forever, right? I saw an opportunity and obviously we made some life-changing money in regards to that one. Celsius Holdings, just 9 months ago. This was a very hated stock. You could buy shares at $21. Today, people are willing to pay $59 for that hated stock because it had crashed from 100 down to 20. AMD, look at this, just a few months ago. Just a few months ago, when I would talk about AMD, people would leave comments like, oh, it's advanced money destroyer, right? Advanced money decimator, like things like that, right? As a play on the AMD word choice. And now people are like, oh, it's advanced money duplicator. We're now at $374,000 on that stock, right? So you look at these gains over time, right? 142% in Celsius so far. Tesla was a life changer. Meta, $848,000 of profits there. SoFi, 269% profits. Palantir, 2,716%. I can go through a long list of hated stocks. Sometimes those are where you'll find the best return profiles you could ever imagine. When a stock's super loved, doesn't mean you can't make money there. It's just there's not as much money to be made, okay? I hope you guys enjoyed today's video. I hope you learn from the process in this video. Whenever I share these stocks with you, it's not just about the particular stocks, it's about the process. Somebody that's been doing this for 17 years now, stock picking. One thing only I need from you guys, if you could please just smash that like button on this video. That would make my day. That's all I need from you. That's your whole payment for today. Just hit the little like button. I hope you can do that for me. It means so much. And additionally, if you want to be subscribed to the channel, you can certainly subscribe. We're now at, oh gosh, well over 900,000 subscribers here on the channel, okay? Just in the past week, we have received over 500 applications to join the Prep Stock Group. That's unbelievable. I'm super happy everybody's taking investing serious or starting to take it serious and being like, hey, you know what? Let me get up to a higher level. Let me get access to all Jeremy's course curriculums and things like that, right? I'm likely going to close my private stock group to new members, likely I would say in the next 30 to 45 days. And the reason being is it's just been overwhelming demand. Like we're not used to 500 applications, like, an average week, maybe 100 applications. And I have a very small team, so we can't keep like this massive influx. So if you want to join us in the private group before I close that down to new members, pinned comment down there here today. Click on that, fill out a form, see if we can get you access in there. It's mayhem in regards to that right now. It's insane, right? And then as far as when I would open it back up to new members, I would say at some point in 2026. When you join us in there, we'll send you your Steel membership cards, private group card, 1000X card, and if you join us on a lifetime basis, your lifetime access card. Ooh, I can't even show you that one. That was just too beautiful. Okay. Alrighty, guys. Let's go ahead. Let's get rolling here. Number one of these 4 stocks. This is a value stock, a dividend stock, and it's got 10 years of growth ahead. And you know what stock it is? Cheesecake Factory. This photo is actually, I ate at Cheesecake Factory literally last night, okay? And so Cheesecake Factory, some people look at the stock and they're like, big deal, Cheesecake Factory. This is one of the most exciting stocks, in my opinion, in the entire stock market one can invest into for the next 5 to 10 years, okay? They have unbelievable growth ahead for this company, right? Now, Cheesecake was a loved stock. earlier this year. The stock had ran from, let's call it the 40s all the way into the 60s, but now only sitting on a 4% gain over the past year on the stock. And it's actually starting to turn into a hated stock. And wouldn't you believe it, right? And a lot of this has to do with the analyst community. So a lot of analysts have gotten very negative on Cheesecake here very recently. You look at the dates in regards to these, a lot of October 29th, right? Cheesecake Factory is maintained at neutral by B of A Securities. Neutral just means, don't buy it basically, right? And you might wonder, who is paying attention to these analysts? A lot of funds pay attention to them, hedge funds, a lot of high net worth individuals, things like that, right? It's not the right strategy, but they carry a lot of weight. Cheesecake Factory is maintained at underweight by Barclays, basically saying it's going to do worse in the market. Wells Fargo maintained their equal weight, basically saying it's not even worth it. It's just going to do what the S&P 500 does. Equal weight is just a fancy way of saying just buy the S&P 500, right? Cheesecake Factory price target cut to $60 from $70 by Raymond James. Obviously, that's a negative there. The big dog, JP Morgan, they just cut their price target on Cheesecake to $52 from $57. They maintained an underweight, basically saying it's going to do worse in the market, right? That's what we have going on. But there's a few analysts, not very many, that are actually positive on Cheesecake. Cheesecake Factory is maintained at outperformed by Mizuho. They believe the stock's going higher than the market in general. Cheesecake Factory is maintained at a buy by Citigroup. So not everybody's bearish on Cheesecake, but for the most part, people are kind of okay? No. The question is, what did the analysts say? Okay. What do the numbers say? Math matters, okay? We're going to talk about that in this video. Math matters, okay? Here's what the actual numbers say at Cheesecake. I posted this inside my private stock group in the income statements tab where I grade income statements, okay? And I teach you guys how to actually grade your own income statements. So when it comes to Cheesecake, this was a B plus grade, very good, $907 million of revenue from $865 million of revenue. They brought down your two big expenses as a restaurant chain, right? Are food and beverage costs and labor expense. And they brought both of those down as a percent of their revenues, which is impressive overall. Their income from operations went to $37 million from $33 million. Net income went to almost $32 million from $29 million. Diluted EPS 66 cents versus 61 cents in the same quarter last year. So every metric you could pretty much look at in regards to Cake is all trending in the right way. Revenues trending up, margins trending up, profitability trending up on a net income basis, diluted EPS basis, even on a basic basis, everything across the board, right? Now, this is from 1000xstocks.com in the transcript feature. And this was very important, okay? Look at this here for the businesses. Total sales in North Italia, that's their chain that they're going to be able to grow massively in the Italian category for the next probably 10 years. That revenue was up 16% year over year, okay? Other FRC sales from their other concepts, that was up 16% year over year. That's a huge opportunity for the company to expand over the next 5-10 years, right? Additionally, Flower Child, which is the biggest thing the company has going on. That's the one that they could explode to, 1,000 locations, maybe long-term, or certainly at least 500. Flower Child sales were up 31% year over year. And look at even their external bakery sales had a booming quarter. External bakery sales was up 20% year over year. Now, you look at all those numbers, here's the issue, if we want to call it an issue, is Cheesecake Factory, the Cheesecake Factory brand restaurant, that's such a huge component of Cheesecake's overall revenues. And that was only up 1% year over year. So basically, these other categories are much smaller, but they all have unbelievable growth, but they kind of get, let's call it drown out because Cheesecake raw number is so big and that business isn't growing that much, right? But here's my opinion on all this. Who cares? Who cares if Cheesecake's not growing much? I don't care. If Cheesecake revenues are flat, they're up 1%, 2%, 3%, right? I never expect Cheesecake Factory brand to have some booming sales or something like that from that particular chain. That's well established. It's always busy. It is what it is, right? They put up their numbers and that's great. That's an ATM machine to feed North Italia, to feed Flower Child and other concepts for growth. It serves a very important purpose for the company overall. You have this stable cash cow of a business that's extremely profitable that then you can take that money and you can do share buybacks with it. You can pay dividends. And ultimately, what can you really do? Expand locations, which is really what you want to do because that's where your major growth is. Your major growth is not in Cheesecake Factory. It's in Flower Child. It's in North Italia. It's in the other concepts. Or heck, even the bakery was a booming business, right? Now, the other thing you got to understand about this stock is if you look at this industry this year, This industry has been a dumpster fire. It's a hated industry in general this year, right? Cheesecake Factory is down about 2% so far this year. Texas Roadhouse down 11%. Starbucks is down 12% this year. Wingstop is down 27% this year. Chipotle down almost 50% this year, down 47+%. Cava down 54% this year. Oh my gosh. Okay, this industry sucks this year. What else are we going to say? Okay, but the moral of the story is Cake is actually doing very well compared to these other, you would expect, given if I told you all these other companies, Texas Roadhouse, Starbucks, Wingstop, CMG, Cava, you would assume Cake would be down easily double-digit percentages. But the business is so strong, it's been hard to send that stock down like all these other stocks have been going down, right? You want to look at Sweet Green. Sweet Green is supposed to be kind of like a Chipotle, but for salads. Sweet Green stock this year is down over 80%. So when you look at Cake, down 1% or 2% for the year, right? And you look at all these other stocks just getting absolutely pummeled, just understand Cake's doing a lot better job running their business than these other guys are, right? And the other thing is, what? Protection. Cheesecake never trades at crazy valuations. You buy a restaurant chain that has no profits or trades at super high P's, you're setting yourself up for a dangerous situation. Cheesecake, 13 forward P. That gives you so much protection from the downside when you trade at that low of a forward P. It's not even funny, right? Here's my base case for Cheesecake. Here's what I think is going to happen with the stock over the next few years and why this is not a boring stock. This stock is going to be very exciting over the coming years, okay? I believe starting in 2026, they're going to be able to do 7%-ish revenue growth per year. And the reason being is I think we're going to be able to get 1 to 3% a year from Cheesecake, the actual, big chain, okay? And then as far as Flower Child, North Italia, and the other businesses, we're going to get double-digit revenue growth, but those bases are going to continue to grow bigger and bigger and matter much more for the overall revenues for the company, right? So I think 7%-ish revenue growth per year, 2026 to 2029 is very realistic. And I think they'll get a little lift on the net income because I think ultimately I'm looking at North Italia and the amount of liquor sales that happen there, that straight profit. And then Flower Child sets up very well because that's actually a lot of to-go business. I think around half their business, if I recall, is to-go. That's massive. That chain's set up phenomenal for to-go business overall, right? And delivery and all that stuff. So I think they'll get a little lift in net income and margins over the next few years. So I think they'll be able to do 9% net income growth per year on average, right? Now, if you got a restaurant chain here growing 7% per year, top line, 9% bottom line, you're going to be able to command a P that's at least in the mid 20s likely, right? So I put a 25 to 30 here, and that puts the stock somewhere between 123 and 148 come 2029, which gives me, let's call it a high 20s to low 30s CAGR. That to me is not boring. This is what I expect. This is my expectation here. This is like my 80% probabilities to be roughly in this ballpark here. There's no boring stock. This is one of the most exciting stocks to buy for the next 4 years, in my personal opinion, right? This is my bear case for Cheesecake, okay? This would mean kind of like flat revenues every year for Cheesecake 2026 to 2029, right? Which I don't think is very realistic, but that's assuming that. 5% revenue growth, 5% net income growth, so they get no lift in regards to their net income, right? 14 to 19 PE. And still, I get a 6% to 14% CAGR on the stock at a 14 to 19 PE. So even in my bear case, it's still a moneymaker. It's still a moneymaker, right? So here's the way I'll put it to you in regards to Cake, okay? And if I had to put it as simple as possible, for every $1 I put into Cake, I expect to get $2 to $3 out of the stock over the next 5 years. That's a very successful investment. If you could tell me I can put $1 into something and I'm gonna get $2 to $3 out of that thing over the next 5 years, I'm always gonna take that. It's just, I gotta take it. It's too much money to not make it. I gotta take it, right? And the way you gotta think about Cake is it's not just in regards to how much you go up on the stock over time, right? Because they pay dividends every 3 months to all the shareholders, right? Every 3 months, company pays dividends. And over time, I'm sure as the profitability increases, I'm sure they'll up that dividend in the future, right? So think about it in terms of, if you buy, Cake stock at $47, right? You might be thinking about when it goes to $57 and $67 and $77 and all those things, right? Respect, we're trying to do that as well. But also you got to factor in all those dividends received over time. And then you take that dividend money and you either buy more Cake shares with it or you buy other stocks, right? beautiful. Is it beautiful? Okay. So I love Cake stock. I think it's one of the most exciting stocks in the stock market. I've been talking about it for the last few years. I've made a lot of money in the stock, a lot of money. And I think it's just a start. I think there's going to be so much money to be made in the stock over the next 4, 5, 6 years. It's ridiculous. Okay. Alrighty. That's number one of these 4 stocks. Number 2, 4, this one's a turnaround play, a dividend stock and a value stock. Okay. You want to know what it is? It is Estee Lauder, EL stock. This is a sleepy stock, right? I'm now up $42,000 on the stock. That does not include any dividends received from the stock either. $42,000 of gains, and it's actually a relatively new investment for me, right? Do not check out on this stock. When I bring up a stock like Estee Lauder, I know like 90% of my audience is males, right? A lot of people like, oh, it's perfume and beauty products and makeup products. They just check out. No. So no, I want to hear about the company and they're going to go to Mars someday, right? Listen, some of the most money you'll ever make in the stock market. Definitely not betting on companies that are going to Mars. Those are going to zero, okay? It's betting on companies that are in the beauty industry. I can tell you some of the best stocks I've seen in my 17 years in the stock market were beauty-related companies. For instance, one of my best stocks ever is a company named Elf Cosmetics. Unbelievable returns, game-changing, life-changing returns in that stock. Another one of the best stocks I've ever seen is Ulta Beauty. Ulta Beauty, I remember that stock in like 2009, like January 2009, that was like a $5 stock. By January 2024, 15 years later, we're talking that stock was like, almost a $500 stock. You almost got 100x on that, right? Now, I'm not saying EL stock's going to be 100x or 10x or anything like that, but there's a lot of money to be made in the stock. And never check out when it comes to these makeup beauty companies. Their margins are phenomenal. They have loyal customer bases that continue to buy those products over and over again. Do not check out on these companies. They are some of the best opportunities you will ever find in the stock market if you get in at the right price, okay? Now, the brands owned by Estee Lauder, they have a ton of different brands, but some of the ones that are Avinda, that's a popular one in the hair care space. Bobbi Brown, Clinique, obviously the Estee Lauder brand. Jo Malone, I love their colognes, and some of their other products smell phenomenal around your house. Kilian Paris, La Mer, very popular for skincare. Le Labo, they have MAC, The Ordinary, Tom Ford Beauty, Too Faced. Those are just some of the brands for this company overall. Okay. Now, the turnaround's happened. It's now occurring for this company now at this point in time. The company had revenues that were going the wrong way. It went from negative 4% revenue growth to negative 6% to negative 10% to negative almost 12%. Now they just flipped to revenue up 3.57% year over year. The turnaround is happening like right now. Okay. So it's not like, if you bet on the stocks 3 months ago, 6 months ago, when I first started betting on it, it was like you had to have a belief that the turnaround was going to come. Now you have the proof that the turnaround has come, right? Now, the thing you got to understand about EL is this used to be a great, consistent growing company prior to Rona, okay? Look at their revenue growth, 14%, 16%, 18%, 13%, 7%, 7%, 11%, 9%, 10%, 15%. Before Rona, this was a consistent growing company. Rona messed up a lot of things for the business model, right? You had the online channels become much more relevant, and the companies had to pivot it to now they're on Amazon, now they're in TikTok Shop. So they've now pivoted, and so they've started the turnaround in regards to the numbers and whatnot. But Rona definitely messed them up in many various ways, right? And the company's now adapted, and that's what we're going to start to see in the numbers. But you got to understand, this stock was a beast. Like January 2010 through January 2020, this stock returned 745%. Once again, do not sleep on these companies. When you got a great opportunity in the beauty industry, those are literally some of the best returning stocks you will ever find in your entire life. They'll beat tech type returns over the years, right? Now, this was Estee Lauder's most recent report here. They just came out with literally a few days ago. 4% net sales growth, 5% gross profit growth, right? Gross margin of 73.4% from 72.4%, right? Their operating expenses, they brought that down very nicely year over year, down 7%, which means your profitability is going to skyrocket. So they've swung to an operating income now of $169 million from $121 million loss. Operating income margin, 4.9% versus negative 3.6%. Net earnings on the company, $47 million versus $156 million loss. This is just inning one of the turnaround, ladies and gentlemen. This is inning one, okay? Now we'll call it inning two. Inning one was doing all the job cuts, having to restructure the business, like getting, in the online channels and things like that. We'll call this inning two of the turnaround. Okay. There it is right there. Okay. Now, you're going to watch is their revenues continue to go up, and then you're going to watch their net income. You're going to watch their operating income absolutely explode to the upside for this company. Because remember, they're remaining employee light now. So being that they did all these big job cuts, and now you're going to have revenue going up again for the company, profitability is going to explode for this company. Now, as far as where this company used to be at net income wise, they used to do $2 to $3 billion on a good year for net income. Okay. That's what I believe this company is going to get back to. There's no doubt in my mind because they're going to get their revenues back. But the difference is this time, they're actually going to have an employee base that's way leaned out versus what they used to have. So I think ultimately we look at this company a few years from now, they actually have the biggest net incomes we've ever seen in the company's history. But given that I think it's kind of in the bag that they'll get back in the next 2 to 3 years to $2 to $3 billion in net income a year, right? Basically, you can say, okay, a 30p is what you'll pay for a company like Estee Lauder, since it's almost seen as like a SaaS play in regards to like people just continue to buy the product over and over, right? You run out of your makeup, you go buy more makeup. You run out of your skincare, you go buy more skincare, right? So that puts this company, in my opinion, in the next 2 to 3 years at somewhere between a $60 billion and $90 billion market cap, right? Right now, the company is just over a $30 billion market cap. So basically what I'm saying in regards to EL and why this is such an exciting stock is this is a 2 to 3x stock, in my opinion, over the next 24 to 36 months. There aren't a lot of opportunities in the market I can see out there that in the next 24 to 36 months, I feel like I'm going to double or triple on my money. Not very many. And the best part of this is, even when I double or triple my money in the stock, right, I'm going to be able to hold it for years to go after that. As long as the business is in the right trajectory and I'm confident in the management team and the strategies, like I'll be able to hold this for 5, 10, 15, 20 years in the future. These are timeless brands. Many of their brands have been around for, 30, 40, 50, 60, 70, 80, 90 years. It's not like these are just, came out of nowhere. No. They've been around a long time and they got a long way to run in the future. So even after I get my 2x, my 3x on the stock, I could easily hold for years to go in the future and then likely continue to get gains in the stock and make all that sweet dividend money. Keep that in mind, okay? EL, I love that one. Number 3 of these 4 stocks, let's be honest, this is just a pure growth company, okay? Growth, and growth. And you want to know what it is? Amazon, otherwise known as Amazing Zon. That is stock number 3 of 4. Now up $175,000 in the stock in the public account. But I own the stock in the Patreon portfolio heavy. I own this stock in my private portfolios. Like, Amazon, this is just a stock you have to own. You have 3 core businesses of this company. You have the e-commerce business, you have the AWS business, right? And you have the ads business. Now you have a bunch of other random businesses off of those, but those are the 3 core businesses of this company, right? No, Amazon is actually a hated stock, believe it or not. And it's just started a new move here recently. So it's starting to get people a little excited. Like this is like move in the past week, basically, that's starting to get the stock moving. But this stock has been destroyed by the S&P 500 and the NASDAQ over the past 5 years. They may say, why? How? Amazon's grown their business so much the last 5 years. How could they have gotten outperformed by the S&P 500? And not just like a little, wrecked. This company's been wrecked by the S&P 500 and the Qs. 53% gain in the past 5 years. The S&P 500 is up 95%. The Qs are up 114%, right? People are like, this stock is just the worst, right? Here's how that happens. 1, 5 years ago was Rona, right? Everybody is forced to be home. You got the lockdowns or whatever you want to call it, all that stuff at that particular time. Growth rates were exploding for Amazon. People thought that was going to last forever. Those sorts of insane growth rates, obviously, they're going to even out over time, right? So you have that come down. Additionally, people were willing to pay any price for Amazon stock at that particular time because the e-commerce growth was so strong, the AWS growth was so strong. They were willing to pay anything for Amazon, right? When you're willing to pay anything for a stock, there's going to be a lot of pain to come in the future. And that's exactly what we've seen and we witnessed in Amazon over the last 5 years. Massive underperformance. But what you're going to witness over the next 5 years is not only outperformance of Amazon versus the Qs and versus S&P 500, but it's going to be massive outperformance. It's not even going to be in the same stratosphere. You're going to look at Amazon's returns over the next 5 years, and you're going to look at the S&P 500 and the Qs over the next 5 years, and they're not even going to be in the same ballpark. You're going to be in complete shock by how much Amazon essentially outperformed the indexes in general, and honestly, a lot of the Mag 7 stocks as well, right? No, what Wall Street cares about more than anything else, and this was posted on the 1000X X page actually, is AWS growth, Amazon Web Services. And what we just witnessed is a major acceleration of AWS growth. And that's what everybody's been waiting for. And that's why the stock has all of a sudden started to move up in the last week, because they reported this AWS growth was much better than expected. And all of a sudden, Wall Street's like, Amazon's back. Right. Now, additionally, just today, Amazon and OpenAI announced a multi-year strategic partnership. It was a $38 billion deal for AWS, which is quite substantial, right? Now, additionally, in regards to Amazon, is they are laying off 14,000 corporate employees, right? And in regards to this, Andy Jassy says it's a culture. It reminds me a lot of Meta's move in 2023. So kind of at the end of 2022, in the beginning of 2023, Zuckerberg did a mass layoff at Meta, right? Mass layoff, leaned out the organization in a substantial way. And Meta had been overhiring for years, kind of like Amazon likely overhired as well. And Zuckerberg realized, like, we got a lot of players that are not A players at this company. I guarantee the same thing happened at Amazon. They probably hired so many employees that were just okay. And if you want to be a high-performing organization, you can't hire okay people. You need to hire the best of the best. And there's just no way a company like Amazon, everybody there is the best of the best. There's just no way they're all A players. Not going to happen. They probably had a lot of D and C players. They probably did, right? Maybe even some B minus players. And they said, we got to get rid of those individuals, right? That's what ends up happening. And so that's business, right? It's not personal, it's business. And they had to make that move. And what that's going to end up producing is likely Amazon's culture is going to end up being a lot better over the coming years, right? Because A players don't want to be around C players. I can tell you that much. That's brutal. It brings the whole team down essentially, right? And additionally, this is obviously a huge cost cutting measure. It hurts profitability in the short term because you got a bunch of one-time costs that kind of take effect over a quarter or two. But over time, obviously, it's going to bring down Amazon's expense profile substantially, and their profitability is going to explode way faster than revenue. So if you're thinking about this company growing revenues at 15%, let's say, don't be surprised if net income's going up at a 30 or 40% clip in that sort of situation, right? Now, in regards to Amazon's latest quarter, $180 billion from $158 billion. Income before income tax is $28 billion versus $18 billion. Net income almost over $21 billion from $15 billion in net income. Diluted EPS $1.95 from $1.43 for Amazon. Huge improvements there, right? Now, the only thing I kind of poked at and why I gave them a B minus grade is some of their expenses were definitely high. Cost of sales was a bit high. Technology and infrastructure was a bit high. And then they had this total operating expense that hit them. That was about $2.8 billion there. So that's why I graded them. Now, what's my bull case, base case, and bear case for Amazon? Well, here's the thing you got to understand. Listen, I might take these numbers up. In regards to my bull case, my base case, my biggest thing is I need to see that AWS growth next quarter. If that AWS growth accelerates again to, let's say, 22, 23, 24%, all my numbers you're witnessing here have to go up on my bull case and my base case, okay? So just understand what you're seeing in front of you right now. I might have to make adjustments 3 months from now, okay? I've been doing 14% revenue growth as of right now for 2026 to 2029 and 20% net income growth, okay? If I got that company like Amazon growing at those sorts of rates, 35 to 40 P is fair, rated about a double an average stock in the market. They're doing over double revenue growth, over double net income growth. So you should be able to command at least a double PE, right? 20 to 24% CAGR in the stock over the coming years, right? Remember, if AWS growth goes 22, 24%, 25% or something like that, this bull case you're witnessing here, this is going to become my base case essentially, okay? My base case, honestly, probably need to take that up to where the bull case is right now, right? Because as of right now, my base case has only 12% revenue growth, which is, much slower growth than obviously what they have right now. Net income growth at 18%, 33 to 38 P would be fair for a company like Amazon growing at this sort of rate, which gives you a compounding annual growth rate of 16% to 20% for this company. This probably needs to come up, right? My bear case, I won't move this one. I'll keep this one here. 10% revenue growth on average per year for the next 4 years, 15% net income growth on average for the next 4 years, 30 to 35 PE, and I still get a double-digit CAGR between now and 2029. I got to buy it. Like, you got to own it, man. Amazon's a must-own in every single portfolio out there. It is a must-own. Number 4 of these 4 stocks. This one's interesting. Okay, this is a turnaround play. A value stock and a dividend stock, okay? They just started paying a dividend. They're going to pay their first dividend ever. This is an ultra level of hatred for the stock. And I understand it, but I don't really care. Stock's going to do amazing. Oh, it's funny. An Amazon truck's literally going by my house right now, okay? You know what stock it is? PayPal. PYPL. A $68 stock. This has been a brutal stock the past 5 years, down 63%. And you know how much I could care about it? Zero, like Robert De Niro. I don't care. Okay. Here's the deal in regards to PayPal. The company, for good reason, was a company that people hated, right? I mean, the revenue just kept getting worse and worse. 9% revenue growth went down to 8%, went down to 5%, went down to 4%, went down to 1% revenue growth, right? I understand it, but that's the old and this is a new, and the turnaround has clearly started. It went from 1% revenue growth to 5% to this latest quarter over 7% revenue growth. And the stock's not reflecting it. The stock is not reflecting the fact that this business model has changed. In my opinion, it's a lot of tax loss harvesting you have at the end of the year, right? There's basically almost everybody that's ever bought PayPal stock has lost money. So if you need a stock to sell and write off against your gains, in your other stocks, so you don't have to get hit by as big a tax bill, look no different than PayPal. But the bottom line is the turnaround's clearly started. It's mathematically proven now at this point in time, right? The income statement was a grade A, great numbers. It would have been an A plus if they just had a little faster revenue growth, right? If they had like double-digit revenue growth, I would have graded them an A plus. $7.8 billion of revenue went to $8.4 billion of revenue. Operating income went to $1.5 billion plus from $1.3 billion. Income before income taxes went to $1.5 billion from $1.3 billion. Net income went to $1.2 billion from just over $1 billion. Diluted EPS $1.30 versus 99 cents. What is my bull case, base case, and bear case for PayPal stock? This is my bull case. 9% revenue growth on average per year, right? Venmo's grown revenue 20%, they said in this latest quarter. 11% net income growth. 20 to 25 PE, nothing crazy at all for a company growing 9%, 11% top line, bottom line. 20 to 25 PE, that's basically just a market multiple with above market multiple revenue growth and net income growth. That gives me a compound annual growth rate in the 20s to potentially 30%. Like, steal deal. My base case, this is just a fancy way of saying what I expect for PayPal. 7% revenue growth on average, 2026 to 2029. 9% net income growth on average, 2026 to 2029. We got an 18 to 23 PE. Steal deal, right? That's higher revenue growth than average and higher net income growth than average, and just a PE that's basically average or even below. And I get a 20% CAGR on the stock. Got to buy it. Even my bear case, only 3% revenue growth, right? 5% net income growth, 14 to 17 PE, and it's still a moneymaker. Give me the stock, man. Give me the dang flipping flapjack and stock. Flip my flapjacks. That's a holy smokes, this ain't no jokers. Like, gotta take it, okay? The thing I want to leave you with in this video here today, there's a lot of talk out there in the stock market about this company's going to do that, this company's going to do this someday, blah, 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 right? And hopes of this and dreams of this and those sorts of things. And a lot of that you get into when you've been in a 3-year bull market, right? Math matters. You got to bring it back to the math. And what I just took you through here today is not just talk about what the business models can do, right? And there's this business line and Cheesecake, they could grow in North Italia and Flower Child, blah, 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 right? It's bringing it back to the math. What's the valuation right now? What's the valuation likely to go over the next 4 years? Am I getting a great CAGR on the stock likely? Yes. The math. Run it back to the math. You gotta work your math. You gotta run your projections whenever you go to buy a stock. You don't do that and it'll come back to bite you huge. Come back to bite you in 2 ways. First, you will get into stocks that will produce you horrible returns. Some of these stocks I just shared with you have been horrible performers over the past 5 years. I do not believe they're going to be over the next 5 years, but they were horrible because people didn't run their math and they paid crazy valuations for them, right? That's a problem. And 2, you got to figure out, like, is this a good deal or not? Right? Because if you get into a stock, and let's say it doesn't do horrible, but you could have gotten in another stock that would have done a lot better if you just ran the numbers and ran the math and took out opinions, right? You might have realized, oh crap, man, I made 5% a year on this stock, right? From 2026 to 2029, maybe you make 5% CAGR versus you could have made 15% CAGR or 20% CAGR on a stock, right? And that completely changed your profile, and that completely then changes what? your lifestyle, your dreams, like what type of house you can afford, what type of cars you can have, when you can retire, how comfortable your retirement can be. Can you retire family members? Can you help out family members? Can you give money to charity? And can you go traveling, do the type of trips you actually want to do and live the type of lifestyle you want to do and buy the sort of car you want to buy and all that stuff? Math matters, because that math then ends up dictating lifestyle long term. And once you understand that in your mind, you realize, oh crap, man, like there's a lot to this game, right? And it really matters substantially. I appreciate you for joining me here today. Pin comment down there if you're looking to apply to our private stock group. Once again, I'll likely be closing that down to new members sometime soon. So if you want to get in there before we close down to new members, and we'll reopen at some point in 2026 to new members, but that'll be pinned comment down there. Access to all my course curriculums, access to 1000xstocks.com to run your numbers. Math matters. Get access to private Discord chat. See the stocks I'm buying and selling. My $4 million Fidelity account. Exclusive weekly videos. All that good stuff. Take your game up to a much higher level. And then we will send you your Steel membership cards to your house. Your 1000x card. Your beautiful private stock group card, which that is a particular stock there. And if you join us on a lifetime basis, we'll send you your black card in the mail as well. Okay. And when I saw these Palantir results and what's going on with this business model, this is changing everything forever. And I'm like, I have to record a video on this. This is ridiculous. I was expecting Palantir to come in with beats. Oh, they're going to beat revenue. They're going to beat earnings per share a bit. They're going to come in with a really strong guidance. What just transpired here is game changing. And I got to cover this for you guys here today. We got to talk about everything going on here in regards to Palantir. Where's the stock going from here? Okay. We're going to talk about that. The numbers. We got to get into that. My perspective on this, right? I wanted to listen to an analyst here who's I recorded this on Fubo just a bit ago, who is, let's call it bearish on Palantir and has a $60.
Brent, want to get your thoughts on
this man. He has a $60 price target on Palantir, so I'm looking forward to reacting to that one. And then I just had to update all of my new numbers for Palantir. Given these results, I don't usually do that, but the results were so insane that I actually had to completely readjust my projections for where Palantir stock is going over the next 4 years. I need to show that in this video as well. It's going to be a busy action-packed one. I hope you guys enjoy this one. This is just a very last-minute video. All I need from you guys is just smash that thumbs up button for me. If you can just do that, that would mean the world. That's all I need from you. Just smash that like button. If you want to be subscribed to the channel, you can certainly subscribe. We are now at 116,000 subscribers or 117,000. I appreciate every single person for being here. Additionally, the pinned comment down there today, if you're looking to apply to our private stock group, private wealth group, I'm going to likely have to shut that down to new members, likely either this month or next month. The demand's been ridiculous. Just last week, we had over 500 people apply to join my private stock group. So demand's been absolutely ridiculous when it comes to that. So yeah, I'll probably shut it down to new members either this month or next month. We'll see who can get in there before I close it. And then I'll probably open it back up at some point in 2026. But my guys, I got a very small team that works for me. They can't even keep up with the demand. So once you join us in there, we'll send you your Steel membership cards to 1000x, your Steel membership card for the private group as well, that beauty, and your lifetime membership card if you become a lifetime member of the private group 1000x as well. That will be the pinned comment down there. Access to all my course curriculums, Discord chat, exclusive weekly videos, all that good stuff. Okay. Let me say this right off the bat. Okay. This is very important. I say this in regards to Palantir before we even get into the numbers, everything that's completely changed for Palantir's business model moving forward. Okay. Listen, it pretty much took a miracle for Palantir to report a quarter that this stock would not go down. This is one of the worst setups I've ever seen in history when it comes to a stock going into their earnings. The stock was skyrocketing into earnings, even strong on earnings day. It trades at one of the highest price to sales ratios we've ever seen in history for any company in the SaaS space. One of the highest trailing 12-month PEs we've ever seen in history for the SaaS space. The setup was horrible. So this was a quarter that if they came in and they beat numbers, but they weren't this insane, let's be very crystal clear about this. This stock would be down 10, 20% after hours. And the fact that the stock's not down shows you how insane these results are. I mean, absolutely astonishing results in regards to this company. Okay. So what happened here? What's going on with Palantir? Why does this change everything forever? Well, they started out this presentation by just straight flexing on everybody. And as they should, okay? They show their rule of 40. The rule of 40, very popular rule of 40 for SaaS companies, right? This is insane. So it's basically revenue, looking at your revenue growth and what your operating margins are, right? And Palantir's at 114% now at this point in time. I mean, that's just ridiculous. That's ridiculous. 114%. They're in a whole different stratosphere than every other company kind of in the SaaS space. Like no one's even in the same category. Like it's just ridiculous, right? And by the way, Palantir takes their adjusted operating margin. So revenue growth plus adjusted operating margin. That's how they get to 114%, right? But then they took it a step further and they said, let's compare it against companies in general, globally, not just SaaS companies, right? And look at this. They're at this 114% number. Only number we can find, somewhat close is NVIDIA there at 120%. Like that's just ridiculous, right? Ridiculous. US revenue grew 77% year over year. How many companies do you know growing 77% revenues? Heck, even the almighty NVIDIA is not growing 77% anymore. That's ridiculous. 20% quarter over quarter growth, sequential growth. U.S. commercial revenue growth. Remember, why did I invest in Palantir years ago when the stock was a $6, $7, $8 stock? Is because I saw there being a massive opportunity for this company to grow their commercial revenue. Everybody looked at the defense business, the government business. That put me to sleep. I'm like, that's cool. That's a steady business, whatever. That's not why I'm in this. I don't care about, what they got going on for military, like whatever. I'm in this for the commercial growth. That's how this becomes a multi-$100 billion company or maybe a $1 trillion company someday, right? That's why I was investing in the stock back in 2022 heavily, right? And for me now, I have 1,000 shares in the public account. So we can call it a little over a $200,000 position. And it's the third biggest position for me in my Patreon portfolio, only trailing AMD and Shopify. So I invested in this company years ago for that commercial opportunity, and the commercial revenue growth is honestly where it's at. I mean, the growth rates for that business are ridiculous. 121% year over year, 29% quarter over quarter. U.S. government revenue, that also was a very strong quarter. 52% growth year over year, 14% on a sequential basis. Revenue in general for the company, 63% growth. Like, my thought was, okay, maybe Palantir pushes these revenue growth rates up to 52 to 55%. That was kind of my thought. And that's why I wasn't even going to make a Palantir video, because I was thinking, you know what? 55% revenue growth, 52%, like that's going to be a really good number that's going to beat, but nothing crazy. When I saw they had revenue up 63% year over year, I'm like, oh my gosh, like I got to do a video. I can't just not do a video about this. This is ridiculous. Now, if you exclude out the strategic commercial contracts, revenue actually was up 65% year over year. Ridiculous. Rule of 40 score of 114%. Oh my God. I mean, this is just insane, right? Insane. Now, obviously they got the NVIDIA partnership as well, which is, that's one of those things. It's like, it matters. It has potential, big potential, but the question is how much potential, right? But there's no doubt, making a partnership like that is phenomenal. But they go through obviously all their products and whatnot. So we talked about the revenue growth here. Now this is important, right? U.S. commercial remaining deal value is up 199% year over year. The reason that matters so much is if you look at commercial revenue growth in general, it's actually significantly less than the remaining deal value. Okay. So we're talking about, 78 percentage points lower when it comes to commercial revenue than actually the remaining deal value. So think, basically that's a bullish indicator for the next year, next several years. Okay. 2x year over year, U.S. commercial deals closed of $1 million or greater. So doubling up that amount. U.S. commercial deals closed $5 million or greater is up 5x year over year. So basically, they're just knocking out of the ballpark when it comes to selling deals of $5 million or more. Legendary, man. Legendary. Look at U.S. commercial total contract value. 342% growth year over year. What? U.S. commercial total contract value is now up to $1.3 billion. GAAP net income for this company is exploding. Oh my gosh. Look where this company was not that long ago, right? And look what we're talking about now. GAAP net income, $475 million. You'll be flipping my flapjacks. Right? Now, you could run that on a year, basically over a full year. You could say, okay, $2 billion, right? So $2 billion, if we were at a 20 PE, we'd talk about a $40 billion market cap, right? Keep in mind, Palantir's around a $500 billion market cap right now. But obviously, Palantir does not deserve to trade at a market multiple, given the growth rates are not even in the same stratosphere. I mean, we're talking about Palantir's growing revenue 60+% right now. Okay, so listen. If you've got a company, an average company in the stock market, revenue growth, you can kind of think in that 4 to 6% range. So let's say 6%, okay? Palantir just put up 60%. That's 10x, right? 10x what an average stock in the market puts up, right, for revenue growth. Okay, so basically we have a situation where if they're growing 10x faster, then they should command a 10x PE more, right? A 10x PE more would be, let's call it a 200 PE. Well, if the company's going to do $200 million or so in net income here, right? Well, then you can say, all right, you could probably slap a 200 PE on that sort of stock, right? And then we're talking about a company that, 200 times 2 billion is a $400 billion market cap. So, at 400 billion, given the growth rates, it's actually somewhat realistic number just because the growth rates are down. Now, where you have an issue is if those growth rates start to go down. So if those growth rates start to contract and all of a sudden they go from 63% revenue growth to, let's say, 30% revenue growth, well, now we could say, okay, they're only maybe 6x or 5x. Let's say 5x in average stocks revenue growth. So now they only command a 5x valuation. So now we say, okay, they command like 100 PE. So then the company has to get to a place where they have net income incoming, right, of, $4 billion plus a year. Because then you could slap 100 PE on it and then you're at a $400 billion market cap, right? So that's how you play the game of how's this stock valued versus other companies in the market, where their growth rate's at. Does this make sense, right? So Palantir doesn't have the thing to understand about Palantir is it doesn't have that forward PE on it for no reason. The reason it has it is because the growth rates are so far superior versus an average stock in the market. And that's what you got to understand about that whole game. Now, something I don't think anybody's talking about in regards to Palantir's net income, that this really matters significantly, okay? Listen, Palantir is growing their profitability much more rapidly than anybody expected, which means what? They're going to have way more money on the balance sheet. If they have way more money on the balance sheet, guess what they can do with all that cash? They can stuff it into treasuries. When they stuff it into treasuries, getting them 4% or so, and it's way more money than anybody expected, it helps the profitability even more. It helps them make even more money. And so you get in this like beautiful cycle of like the profitability is way better than anybody anticipated. They put even more money into treasuries, right? That money can make them even more money than people thought. And the business is doing better. So it's like a super compound here of just like, way better net incomes than anybody anticipated, right? And earnings per share. So, that's just something to kind of keep in mind here, right? Now, as far as their GAAP operating margin, so generally accepting accounting principles, this isn't like taking out one-time adjustments and things like that. This still came in at a very impressive 33%. Rule of 40, we spoke about that, 114%. I mean, it was already insane. When it went to the 80s, that was already ridiculous, right? It was like 80s? Like who does it 80s? Then last quarter, they came in with 94%. This quarter, 114%. So that's the other thing I'll say about Palantir. A lot of people say, we've never seen anything like this before. We've never seen a stock trade at this sort of, price to sales ratio, right? And that's fair. But you ever seen a company in the SaaS space have a rule of 40 of 114%? It is a 101. Like, we do have to admit that. Like, you can say a lot of things about Palantir's valuation. We can talk night and day about trailing 12-month Ps and forward Ps and 2-year forward Ps and how much growth they need to have over the coming years to make. We can have that debate all day. But what you cannot talk about is this is a 101. We haven't seen a company reporting these sorts of numbers. Like, this is just ridiculous, right? Absolutely insane. U.S. commercial revenue growth was up 77% year over year, obviously driven by that U.S. commercial business. That's ridiculous. Government business is actually a drag, which still like 52% revenue growth for the U.S. government is insane, right? Now, so I got to caution everybody. Something I do worry about is government revenue in future years, okay? Not in terms of is that government revenue going to come in? No, it's just that growth rate. I do worry about Palantir being able to sustainably grow the government business at a very high clip like they're growing at right now, okay? U.S. commercial, like they have still a lot of room to grow that business. The government business, I have a little bit more worry about that, but we'll see. They have made a lot of strategic deals with the government, so that's just something to keep in mind there, right? Commercial revenue growth in general, 73%. Keep in mind, guess what? Europe is still a drag on the business overall. Like their US businesses continue to grow phenomenally, right? 65% growth here, like we talked about with the strategic contracts. We continue to invest aggressively in AIP in the US while driving operating leverage at scale here. So they're showing their adjusted operating margin, $601 million, representing a margin of 51%. So that's up from 46%. So we have expanding revenue growth, expanding margins, expanding earnings per share, expanding net income. The question is, how long can they put this up for, right? They can keep putting this up, like, just party on. But as soon as these numbers, just remember, ladies and gentlemen, okay? Just remember, I got to caution everybody. Listen, as soon as these numbers start to decelerate, you're going to have big problems in Palantir stock. I can promise you that. But for right now, as long as you keep accelerating these numbers, but we know at some point in time the party's going to come over, just as all parties do end, right? But for right now, man, it's just acceleration after acceleration after acceleration. Customer count grew 45% year over year. Commercial customer count grew 49% year over year. That's a really strong number. 204 deals closed of at least $1 million. 91 deals that were at least $5 million. 53 deals that were at least $10 million. Remember I spoke about cash, treasuries, all that stuff, right? They're up to $6.4 billion in cash equivalents, in U.S. Treasury securities, and no debt. Woo-wee! So for the fourth quarter, they're now expecting $1.32 billion to $1.33 billion of revenue. They're talking about adjusted income from operations, right around $700 million roughly, right? I mean, these numbers are astonishing, absolutely astonishing, better than really anybody anticipated here. So, okay, so next up here, okay, in regards to Palantir, right? I posted this on X just a bit ago. I said, you know, we can say a lot of things about Palantir's valuation, but we can't say anything about the fundamentals. I just graded their income statement here, folks. That's an A+. That's an A+. Look at the interest income, by the way, almost $60 million. Even though technically treasuries are kind of yielding a little less, like Palantir's still able to continue to build that interest income up. And it's because like they have more and more cash on the balance sheet. So they're able to get more and more out of their money. But it's an A+. That's perfect, right? Their balance sheet's perfect. Their cash flow is perfect. Like everything about this company is literally perfect on the fundamentals. The valuation's all you have to really poke at this company right now. You will have a big case to be made when this company's growth rates start to decelerate. When that happens, then you'll have something to talk about, right? Because then it'll be, oh, Palantir's got a crazy valuation on it and their growth rates are decelerating. But that's not the case right now. They're still in the acceleration mode, right? I said if Palantir didn't have a sky-high valuation on the stock, on these earnings results, the stock would be up 20+% after hours. Easily, right? Easily. So yeah, man, absolutely unbelievable. Okay, so next up here, I want to get into this bearish commentary around Palantir. And then from there, I'm going to share with you my new projections, my updated projections in regards to Palantir. Here we go.
170%. That pushed its forward price to sales ratio to 85 times. It's the highest in the S&P. So let's bring in Brent Thill, Jefferies equity analyst. He has accelerating a $60 price target. Brent, want to get your thoughts on this report and what it's going to take for you to perhaps change your tune on Palantir.
By the way, before we go further here, okay, this man with this $60 price target makes no sense. No sense. You could make a strong argument that Palantir could be dead money the next 3 to 5 years. You can make a strong argument for that, right? $60 price target doesn't make sense. This company's growing revenues at least 10x an average company. So if they were at a $60 stock price right now, the forward P on Palantir, oh gosh, the forward P might be, I don't know, 50 or so, right? 50 or 60 or something like that. So we can say maybe 2.5x to 3x. If the company's growing revenues 10x faster, if they're growing their net income way over 10x faster, if not 15 or 20x faster, it doesn't make sense to only have the company valued at 2.5x or 3x an average company in the market. Even if it was 5x, it still wouldn't make sense. Not when you're growing your revenues and your net income, your earnings per share way over 10x an average stock. Like, so his $60 price target is just ridiculous. Like I said, you could make a strong argument that Palantir could be dead money for the next 3 to 5 years, but throwing a $60 price target, that just shows me you probably don't know how to actually run valuations, at least in my personal opinion, or whoever taught you doesn't know how to actually run valuations on companies.
Solid. The valuation is like anything we've ever seen, trading at 90 times revenue. So there's no way you can put any valuation metric on the actual valuation. Again, we've never seen anything like this.
True, but in all due respect, sir, you know what else we've never seen anything like? We've never, ever seen anything quite like this. 100, all due respect, I got to push back, like 114%. Whew, like that's ridiculous. Like just ridiculous.
And see anything like it as well. So to split the two, we've said repeatedly, the fundamentals remain exceptional. The question is this the best place to put your capital based on all the other trends that are going on? You can buy Amazon at 15 times EBITDA. You can buy Palantir at 90 times revenue. So we've been arguing that we feel there's a better use of capital in other places. We've been wrong for part of this call on Palantir, but I think we've been right in those other names, just given the valuation concern, and they continue to execute at an incredible high level. So there's nothing to really take away. The government business decelerated a little bit, 52% versus 53% last quarter. If you want to nitpick, obviously the government shut down. What's that going to do to the business? But ultimately, the commercial business is crushing it. They're putting up great numbers. And as Dr. Karp has said repeatedly, we haven't seen numbers like this from a software company. We've covered software for 30 years. There's nothing like this to compare it against.
So if we have nothing like it to compare it against, how do you get to a $60 price target?
25 times revenue, which would be one of the highest multiples in software right now. If you look across the entire industry, the highest multiple in our industry, whether it's Cloudflare,
already it shows me whoever taught him how to value companies did not teach him the right way. Mr. Buffett, he taught me a little something about bottom lines, about profitability. Once companies are profitable and sustainably profitable, you are to look at the P ratios, the price to earnings ratios, right? And then you got to look at what is revenue growth, what's net income growth, earnings per share growth for that company. And then you can figure out how to properly value a company. Price to sales ratios are relevant in two scenarios. I'm giving out game here, okay? Listen, ladies and gentlemen, I hope this gentleman watched the video so maybe you can get up on valuations here and how to run these companies properly, okay? Listen, when you're talking about price to sales ratios, it matters if you've got a company that is not profitable. If you've got a company that is not profitable, or maybe they're profitable one quarter, then they're not profitable, value them on price to sales ratio. That makes the most sense, because how are you going to value them on the earnings? They don't have earnings yet, okay? The second scenario, if you want to look at price to sales ratio, is when you're comparing multiple companies versus each other from the same industry. That is another place where a price to sales ratio is relevant. Those two scenarios. But for sustainably profitable companies, price to sales ratio is just not the metric you should be looking at. You should be looking at forward PE, trailing 12-month PE, 2-year forward PE. Those matter much more significantly, okay? All this stuff I'm talking about here, I go into all this in the course curriculums inside my private group. That's just one of many reasons. So you can learn all these gems I got out here to teach you how to do this stuff on a high level and not be like, just gambling money around there, or you're looking at the wrong stuff. And I'm like, oh my gosh, like these guys are looking at the wrong stuff. And then they wonder why they got a $60 price target on the stock and the stock's 200, right? Like, come on.
These are phenomenal companies that are producing huge returns that trade at those multiples. And so you have to assume that this execution continues consistently for years for that multiple to come down. We've never seen a 90 multiple. And look at the numbers. Why is the stock flat? Because it's flat because the multiple is so high and there's no real room on the multiple expansion to go. So again, I go back to way better other stories in AI to invest in that I have more conviction in.
So that's a perfect point he brings up there. There's a fair point. The reason the stock's not moving in any substantial way is because the valuation. He's 100% right. Yeah, like I said, like if this stock was $100 stock right now, the stock would be up 20+% after hours easily. On these results, on how shocking they were, like yes, but the stock's not moving big. Like, look at the stock, 208 after hours. Like it's because that valuation. So that I'll give him credit. That he's 100% on with.
Investors sitting at home, though, I think I would wonder, is Brent Thill just stuck? I mean, you had the $60 price target. It's over 200. Like, you could double your price target and still have a strong sell on the thing. So how does this work?
True.
Like, do you have to stay at 60 just because, in for a penny, in for a pound?
Mm-hmm.
No, I think we look at multiples. We've been doing this for a long time, John. This isn't our first rodeo. So when we saw Snowflake implode, Datadog implode, we weren't on the Snowflake trade. We had a hold. And everyone's like, why don't you have a buy? And ultimately, there's a point where these crack. Palantir has done a phenomenal job. But when you look at so many other names in AI across our tech franchise that we cover, many of these names were up 50 to 100%. So would we like 150, 160% return that Palantir's had year to date? Great. We have a safety net around other names that are up 50 to 100+%. And so, again, it's a relative bet. And I think when you look across institutional money managers, they're made the same bet. A lot of our clients have made the wrong bet, not betting with Palantir. And ultimately, it comes down to valuation. The retail investor can bet because they don't really know the valuation. They don't know it trades. You can literally take a 60-point multiple between the second highest ranked name, which is Cloudflare or CrowdStrike, and the gap between that and Palantir is like 60.
In all due respect, sir, you're dissing on retail investors not knowing how to value this. In all due respect to you, sir, you're valuing a profitable company that's sustainably profitable on a price to sales ratio. That's not how you do this game either. So I don't know how much you can poke at the retail traders that are involved in Palantir stock when you're not even valuing it properly.
See, it's a number that we don't feel comfortable with.
Okay.
And we feel comfortable, again, with others. I'm not taking anything away from the fundamentals. Fundamentals are great.
All right. Well, that's why Alex Karp keeps talking about it. Brent Thill, thank you.
Yeah, and no doubt the fundamentals are phenomenal, right? Now, he mentions the stock's going to crack, right? And then we'll get into my new valuations versus my old valuations and things like that, right? He mentions about eventually the stock's going to crack. 100% accurate. 100% accurate. Eventually, Palantir stock's going to crack. As the stock market will eventually crack, as it always does, right? And every stock in history always eventually cracks, right? And Palantir will be no different. It's already cracked in the past, right? Years ago. You'll have the next crack. But the question is, when? When does it have the next crack, right? I'll tell you exactly when. As soon as the revenue growth starts to decelerate, the stock will have already cracked. You'll start to see the stock price move down before you see the numbers. So basically what will happen with Palantir stock is it'll get to a certain level and it'll kind of get stuck at a level. And then the stock will start going down actually because word starts getting out about these companies. Executives talk to executives and talk to other high net worth individuals. And so the people in the know, right? And that'll be the moment when okay, the growth is starting to decelerate. You'll see it in the stock price before you actually see it in the numbers, okay? Then from what will happen there is the numbers will start coming out and they'll start to show deceleration. And that's when people start really getting freaked out. Like, oh my gosh, shoot, the growth, and it's still going to be great growth rates and people are still going to talk about it. Yeah, they didn't grow as fast as a percent as they did last year or as fast as a percent as this quarter, but you know what? They're still growing great, right? Stock will already be moving down by that point in time. And so that'll be the moment, but when is that? Right? I don't know. Maybe it's next quarter. Maybe it's a quarter after. It's probably in the next few quarters. I have my doubts about this company can be able to accelerate revenue growth to 70% and then 80% and then 90%, then 100%, then 110%, 120%. It's completely unrealistic, obviously, right? So eventually this thing's going to head the other way when it comes to revenue growth. My guess is probably in the next few quarters because the issue you got to keep in mind here in regards to Palantir is remember this. When it comes to these companies, they always have to eventually comp against the previous year's numbers, which means these insane quarters Palantir's putting up right now that everybody's, obviously cheering and we're talking about it, oh my gosh, these numbers are so amazing. Eventually, Palantir's going to have to comp against this quarter. Now, to show another 60, let's say this time next year, to show another 63% revenue growth on this quarter where we had 63% revenue growth, that's difficult. Not impossible, but very difficult. Okay. Very low probability that happens, right? So by this time next year, we're probably already seeing decelerating growth rates. And that doesn't mean it's the end of the world for Palantir. They're doomed or something like that. It's just Maybe this quarter was their top for revenue growth. Maybe it's next quarter. Maybe they get up to 69%, maybe 70%, something like that, or 65%. And then from there, they start to kind of flatline revenue growth a little bit in terms of that maybe staying in the 60s, and then they go down to maybe the 50s or something like that, right? And that's still amazing. Like, how many companies growing 50%? But the problem is you'll have a problem in the stock price at that point in time. It won't be a company problem. It's going to be a stock price problem, okay? So my old Palantir projections, I had a bull case where they averaged 40% revenue growth a year, 2026 to 2029, and they averaged 50% net income growth on average for those years. And then I had them at 120 to 140p for my bull case, and that gave me about 14% compound annual growth rate to 18%, right? Keep in mind, my bull case is always a lower probability. My bull case for companies, I would usually put around like the 10% probability, right? So low probability, but it's possible. Now, as far as my base case, which I usually put as like 60% plus probability, right? If not 80% probability of them being somewhere in this ballpark, this is what I expected for Palantir before today's numbers. 40% revenue growth in 26, 38% 27, 35% 28, 30% 29, 50% net income growth 26, 40%, 38%, then 35%, 85 to 100 PE, and basically the stock's flat for me for the next several years, right? And that's what I think is most realistic. And that's why I've been cashing Palantir shares, right? But given how insane these results are and how far they push up the growth rates, I didn't see this company getting a 60% revenue growth rate. They've done far better than I anticipated, right? I thought, okay, high 40s, maybe 50%, but then to see them push 60 plus percent is ridiculous, right? So I had to up all my numbers here. So I upped my bull case now to 45% revenue growth on average per year, 2026 to 2029. Okay, that's, once again, probably only a 10% chance this happens, but gosh, legendary if they do that. I had them doing 55% net income growth on average per year, 26 to 29. They do that. I mean, 125 to 145 PE is pretty fair for the company, right? And that would give you a compound annual growth rate of that 20% range, which would mean Palantir even buying today, the 10% probability that this bull case comes true, that would mean Palantir's actually still buy right now. Because, 20% CAGR, like, you'd be doing very well. But once again, I want to push back against that. I don't expect that. Here's what I expect, given the new results. I have them now doing 45% revenue growth in 2026, down to 40% in 27, 38% in 28, 35% in 29, 55% net income growth in 26, 50% in 27, 48% in 28, and 45% in 29. Now, if they're growing top line 35%, bottom line 45% in 29, and they're in the kind of more SaaS category, I think 100 to 120 P is very fair for a company like that, right? Because we say the market in general trades at about a 20-ish PE, but this company we can say is going to grow maybe 5x an average company, or maybe 6x, right? So 100 to 120 P is fair, which still gives you a decent compounding annual growth rate. This is not the best place for your money, right? If my base case comes true. There's a lot better stocks that will make a lot more money than Palantir over the next 4 years, but it's not like it's a bad stock given my new base case. Like, there's a possibility Palantir could outperform the S&P 500. Now, I would say there's an extremely high probability at some point in these next 4 years, Palantir is going to crash. At some point, right? If you buy it on that crash, given that their business is still great, right? It's just people freak out about decelerating growth, or maybe the whole market crashes or something in the next 4 years, right? If you can pick it up during that crash, you could actually get a much better compounded annual growth rate than what we have here. This is just assuming you bought today, right? And then you didn't buy during a crash or something like that, right? So keep that in mind. Now, my bear case for the company, keep in mind, this is still pretty dang bullish, but revenue growth 45% next year. So basically, what am I expecting for revenue growth next year? I'm expecting 45%, which is a really high number because remember, they got to comp all these numbers next year. Difficult, right? 40% 27, down 35% 28, 30% 29, 50% net income growth, 45% net income growth, 40% net income growth, and 35% 29. 80 to 90 PE is pretty fair for a company at those sorts of growth rates in the SaaS category, which, my bear case, if that comes true, I'd call that like a 10% probability, somewhere around there roughly, right? Basically, Palantir is a flat stock. So, I mean, I got to say, I think Palantir could actually still be a moneymaker, surprisingly, over this next 4 years. There will be a crash at some point, if not 2 crashes for Palantir in that mess, in that 4-year span, but it's still actually likely a moneymaker. But once again, it is not the best moneymaker in the market. There's a lot of stocks, better opportunities, in my opinion. even with my bullish numbers here, and I'll talk about some of those on the main channel when I finally release that video, 4 stocks I'm buying, and we'll talk more about other opportunities in the market out there. So just something to kind of keep in mind. But man, Palantir, what an absolute beast. Incredible. Okay. And congratulations to everybody that's made a lot of money in the stock over the last 3 years. It has been a lot of fun. And you don't get these type of opportunities very often in the stock market where you get a chance to make 2,000, 3,000% in a matter of a few years, right? And we've been fortunate to ride this wave over the past 3 years and make, obviously some game-changing money. And to some of you guys, you made life-changing money. And I tip my hat to you. Okay. I appreciate y'all for joining me as always. Thanks so much for being here. Pinned comment down there today will be to apply to join our private stock group, private wealth group, get access to 1000xstocks.com, private Discord chat, exclusive weekly videos from me, all that good stuff. And see the stocks I'm buying and selling in my $4 million Fidelity account, the public account there. And yeah, demand's just been overwhelming. 500 plus applications last week. You'll be flipping my flapjacks. It's insane. Okay. Much love and have a great day.